Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at the frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here's the price action. The payrolls report in a couple of hours' time, looking to set the tone for this market going into the 22nd for the Fed meeting. Equity futures looking to add some weight to all-time highs of the S&P 500. Record high close yesterday, this morning, up 0.2% on the S&P, up a little more than 1/10 on the NASDAQ, and advancing 0.4% on the Russell. That's the equity market. Switch up the board and get to the bond market. 2s, 10s, and 30s. Shaping up as follows on 10s this morning. Just north of 130. Yields higher by a basis point or two. Tom, I want to put two pieces of research, two quotes together. From Bank of America about a month ago, when they said we sat on the threshold of a major bifurcation of scenarios. And Kit Dukes of SocGen this morning, who basically wrote the following, Tom, that new trends need more confidence than the data can easily provide. That data this morning may not provide that confidence for that new trend that we need confidence on. And Tom, that's the problem right now. When you're at an inflection point, one data point doesn't get it done.
But the inflection...
We're working through this mid-cycle transition, Tom. We're still working our way through it.
I'll give you the mid-cycle transition, John, but to me it's the overlay of the uncertainty of a medical event, a natural disaster. Everybody, good people, Kit Dukes, the team at Bank of America, all of them are dealing with what's called, Peter Bernstein would say, you know what, this isn't risk, it's not ambiguity, we're dealing with true uncertainty.
And Tom, for that reason, if you get a miss today, a downside surprise, is there any indication of how good demand is? For this labour market, maybe not. Because the problem hasn't been demand through the year so far, has it? The problem's been supply. We saw that in the ISM. We saw that in the NFIB Small Business Survey. Tom, did you see that? Job opening sky high, compensation through the roof, and they're struggling to fill the positions.
Look, I did this on Twitter today, John. When I was walking down the stairs, I got to like the 32nd floor and took a Twitter break. Target Amsterdam, $15 an hour, $17 an hour, $20 and change an hour, $41,600 a year base pay, plus a $3,000 signing bonus to walk in the door.
I have to admit, Tom, I woke up early this morning and thought you might be considering a career transition. Just, you know, throwing it out there, maybe.
Yeah, you know.
Maybe. Let's finish on foreign exchange.
They have the walker for me at the bottom of the skyscraper.
One of those. Yeah. We shouldn't joke about those things, Tom.
No, we shouldn't.
Euro dollar. Let's finish on that. Switch at the board.
Violating my HR rights.
118.70. Lisa, that's been my crutch for a long time on this program.
It's brilliant.
Euro dollar 118.70, unchanged, Tom. Kit Dukes of SocGen, just wrapping it up in the FX market. Perhaps opening the door, if we get a miss today, opening a door to test 120.
Yes.
Euro dollar right now, Tom, 118.70.
Yeah, worth watching. We've been off the currency watch, and I do agree with John. We've got to watch that. Yen 109.94, right near 110, with the upset of the Prime Minister resigning, stunning resigning, or not running again, I should say, in Japan, a one-year term for Mr. Suga. Right now, Mr. Riccadonna joins us. Carl Riccadonna with Bloomberg Intelligence and their chief industry economist. Carl, you are so good. It's saying there's two reports. There's 42 pages, but here's the one thing I'm really looking at. What's the one thing you're really looking at?
Well, the one thing we're going to have to focus on in today's report is revisiting that K that everyone was talking about last spring when coronavirus broke out, and also in the winter as winter months rolled in November and December of last year, where we saw a re-weakening on that winter wave of the virus. And we saw the category, the well-expected categories like leisure and hospitality and retail and whatnot, starting to show some signs of frailty as the second wave got underway. This time around, it's obviously the Delta variant, and we've seen some frailty in restaurant bookings and hotel reservations, airfares, et cetera. Not a collapse by any means. It's not what we saw in those prior instances, but we're starting to see some fading momentum. And so what we have to do is filter out two factors. One, we've seen some very unusual seasonal factors around education hiring. So you take out state and local education hiring. You also take out, at the very least, leisure and hospitality, if not all of these, sensitive sectors. And then you look at the core underlying momentum in the economy. And last month, that number was closer to 300,000 than the 900,000 headline print that we saw.
Carl, if I plug in 725, I got a 3-month moving average here plugged in of 869,000. We've done 2.6 million jobs in the last 90 days, depending on what we see today. Where's our patience? Don't we just have to wait for a recovery?
I think that we're going to have to wait for the recovery, and some signs are certainly pointing to a weaker than expected number or weaker than consensus number in today's results. I don't think this is a game changer one way or the other, but it will start to beg the question of whether the timeline that Jay Powell laid out at Jackson Hole for tapering can actually hold, or if that taper needs to be nudged into the first part of next year. So, when we get a sense of that underlying momentum, we'll have some clarity on that front. But, in contrast to what your guest, Randy Krosner, said earlier this morning, in the minds of Jay Powell and Lael Brainerd, I'm not so sure that they see a tight labor market right now. As Lael Brainerd looks at the economy, there's an employment gap or deficit of about 8 million jobs. In Jay Powell's mind, just comparing it back to the February 2020 levels, there's still about 5.7 million workers who haven't been replaced in the economy. So, of course, some of those are retirements and things like that that Powell and Brainerd have acknowledged. But the way they're thinking about the economy, there still is considerable slack in the labor market because those workers have not been re-engaged to the economy. If we start proceeding with normalization before that substantial further progress has been achieved, then you really do risk that economic scarring from the pandemic does become a real issue. And Jay Powell, from the very start, has said that it is his priority to ensure that that does not occur.
Well, Carl, let's have that conversation now. What separates the doves from the super doves on the FOMC? Because I'm not sure there are many hawks. We can have that conversation another time. Is it the participation rate in the labor market that separates those two views?
Participation is a core theme underpinning this jobs deficit issue that Brainerd and Powell are so focused on. Yep. And we can see labor participation basically back at Jimmy Carter era levels, and we know that that is not normal for the economy.
Well, wait,
so
I got to interrupt there. This is too important. Carl Riccadonna, are you saying there is a Carter malaise?
I'm saying that the risk is we could create a Carter malaise if the Fed rushes too quickly to normalize policy. And it is very clear from not this Jackson Hole, but last year's Jackson Hole, that the Fed has accepted a different mandate. They realize they're operating in a global phenomenon of low inflation and low interest rates, and this gives them the runway to move very, very gradually towards the policy exit. If they move too quickly, then they're basically hanging that 5.7 million number that I mentioned for Jay Powell, they're hanging them out to dry. And in Jay Powell's mind, moving forward with 5.7 workers not yet re-engaged is not the substantial further progress that he has been telegraphing.
So, Carl, this will come down to communication. And Lisa, let's talk about this right now. Communication around QE on the one hand and what it means for rates on the other. Can the chairman separate the two? And Lisa, I've been asking all the week, through the week, and I think many other people have as well, to what degree does the dot plot on the 22nd compromise that effort, that communication effort on the 22nd?
And to what degree does the uncertainty in the data that you were just talking about undermine that effort to communicate? Because if they're data dependent, we're looking, frankly, at a very difficult landscape to really even predict. And if they say that they're going to change their minds based on that, it really does come down to that. I just want to pick up, Carl, on what you were talking about, the 8 million job openings that Lael Brainerd talks about, the structural gap that they say this labor market still has a lot of slack. What evidence are they pointing to in the granular data that shows that perhaps people haven't just left the market entirely, had an existential crisis, switched careers, gone back to school, all the anecdotal data that we're getting out of a numerous number of studies?
Well, Lisa, we can look at things far beyond just the top-level unemployment statistics, so we can see transitions into different sectors of the labor market and whatnot. And what we know is that certainly there has been an outflow of retirees, but that does not explain this collapse in participation that we've seen. There's a lot of working-age people and young people who simply are not re-engaged. So part of it is a factor that you've highlighted many times on this program, parents who are not able to return to the workforce if they have kids at home doing remote learning, and that requires some level of supervision. So childcare issues is one, fear of the pandemic and the health consequences, especially for those who are vulnerable, is another issue. And the third factor is the sweetened unemployment benefits, which have made it much more appealing to sit on the sidelines and collect an unemployment check rather than return to a minimum wage job or minimum wage adjacent job with very low benefits. Now, just rewinding real quick to Jonathan's point about what the dot plot is going to say, let us not forget the messaging from Jay Powell last time the dot plot was issued, and there was so much excitement in the markets about the potential rate hikes creeping into the horizon. And Jay Powell said they should be taken with a very large grain of salt. He said we didn't even discuss interest rate liftoff at that June meeting. So he did everything in his power to basically downplay the potential signaling from the outline dots on the dot plot. And of course, we have to filter out the hawkish dots from that picture too. And so I think that we, the divorce between taper and rate hikes was established well before the Jackson Hole speech, to those who watch the Fed closely.
Tom, it drives us all nuts. If we shouldn't look at them, why are they there?
I don't get me going. Carl and I.
Well, let's get going now. Carl, why are they there? What are they there for?
Well, they're there to present some sort of framework for understanding how policymakers are thinking about the economy. It is not meant to provide a clear forecast for the future of Fed policy.
John Riccadon and I closed a bar about 3 years ago talking about the dot plots.
It's there to support the reaction function unless it doesn't support the supposed reaction function. Carl, thank you.
Jonathan, it's a useful tool and they should keep it. I know they're always saying get rid of the dot plot. Don't scrap it.
Bad news.
We should continue this debate another time. Carl, thank you. Carl Riccadon, Lisa talking about an existential crisis of some people. Were you talking about someone that might have walked down 50 flights of stairs this morning?
I thought Carl was brilliant. I want to talk about the Carter malaise sometime this morning.
Okay, TK, let's do that. Let's do that. I agree.
Really important.
We can do that a little bit later this morning. Tom Keene, Lisa Bravis, Jonathan Ferro, your equity market up 0.2% on the S&P 500.
If I put Prosecco on my knees, does that work?
It's Payrolls Friday from New York. This is Bloomberg.
With the Fast Word News, I'm Rishka Gupta. The race to succeed Japan's Prime Minister Yoshihide Suga is seen as wide open. In a surprise announcement, Suga said he would resign after failing to control the country's coronavirus surge. It's just weeks before the general election. Whoever becomes the next leader of Suga's Liberal Democratic Party is virtually assured of becoming Prime Minister because of the party's dominance in Parliament. It's a tax settlement that is one of the biggest in U.S. history. The billionaire founder of quant hedge fund manager Renaissance Technologies and his colleagues will pay billions in back taxes, interest and penalties to resolve the case. Senate investigators pegged the amount at a minimum of $6.8 billion. The case has to do with the way the firm converted short-term gains into long-term profits. New York and New Jersey learned that the old norms of wealth no longer apply. The remnants of a hurricane that first New Orleans killed more people in the Northeast than it did on the Gulf Coast. At least 40 people in the region died from floodwaters caused by torrential rains. Airports and commuter trains struggled to resume service. The European Union and AstraZeneca have ended months of bitter fighting over vaccine supplies. They've reached a deal to provide an extra 200 million doses to the bloc. European inoculation campaigns fell behind the UK and the US earlier this year, and the EU accused AstraZeneca of failing to provide sufficient vaccine doses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Session started and wrap up the trading week.
News.
Who knew that one earnings story could tank the entire market?
There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Merkel, after 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early start to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, we see the evidence of that strong consumer.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Even when you have variance,
that do diminish somewhat the efficacy of the vaccines, the vaccines still are quite effective against variants of that type. Bottom line, we're paying attention to it. We take everything like that seriously, but we don't consider it an immediate threat right now.
Dr. Anthony Fauci there from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Your equity market shaping up as follows. This payroll's Friday. Your estimate, 725,000. Your numbers, up 0.2% on the S&P. A record high close in Thursday's session. And we look to add to it this Friday morning. Treasury yields just south of 130 at 129.87. Yields are higher by a little more than a basis point, Tom. And euro dollar totally unchanged. 118.71. Sit tight. 8:30 Eastern, the payrolls report, just around the corner, Tom.
Very good. John, on Labor Day, we're going to digress here off the barbecue and talk about the sanity of American medicine. Andrew Pekos is qualified at Johns Hopkins Bloomberg School of Public Health. I should note, Mr. Bloomberg, a nodding acquaintance with his television and radio property, a philanthropist to his Johns Hopkins University. Andrew, this gets me going because it's what I studied in school. We have miracle drugs for animals that cure heartworm, that cure any number of things, lymphatic filariasis and acariasis or whatever. And we've got people taking ivermectin, et cetera, to cure COVID. How does a medical community respond to such madness?
You know, we try to respond with the facts. In this
case,
that's
not working, Andy. I don't want to cut you off, but it ain't working. How do you get Biden to get the celebrities these clowns care about to actually say, go get vaccinated? Where are the celebrities to tell these people, you got to get off the heartworm drug and get on the Pekos method?
I think you're absolutely right. I think one of the things that we've not been able to do effectively is communicate the safety, the efficacy of the vaccines in the right way to a large swath of the population. And we leave open the opportunity for things like this ivermectin self-medication trend to take hold and go out there because we haven't been able to infiltrate into those social media chains that are propagating that misinformation. It's a massive communication problem now more than it is a scientific data problem.
But even beyond just the people who are against vaccines or who are against a vaccine that is this new, there is a question about the efficacy of the existing vaccines versus some of the new variants. And I'm talking about Delta, I'm talking about Mu, something that Anthony Fauci actually highlighted in a recent interview as something that they are watching. There is concern that just having a vaccination doesn't really protect you, especially if you've got a remask. How should the communication be changed around that to basically encourage people of how much more protected they are when it's unclear?
Well, I think it is clear that we are still seeing a good amount of protection, starting with severe disease, moving to hospitalization, and even going down to symptomatic infections. Yes, Delta is a stronger variant than we've seen previously, and it's sort of knocking on the door, it's banging on the walls a bit more harder, and we're seeing more breakthrough cases with Delta than we saw with previous variants. But the vaccines are still working. All you have to do is look at the numbers of cases and hospitalizations and break them down into vaccinated versus unvaccinated, and you'll see that it's the unvaccinated population that's driving everything.
Dr. Pekos, does it undermine the administration's communication with this exact point, that the vaccines do protect against severe illness, if they reinstate travel bans or they don't allow people from other countries to come here who have been vaccinated with proven to be efficacious vaccines?
I do think that there are some political aspects of this, if I can use that term, that make the message a little bit more murky. You know, we have our own problems here in terms of the pandemic and controlling it, and that should really be our primary sort of aim. And it really is going to be vaccinating the unvaccinated that gets us out of this situation. Boosters will help protect against severe disease in certain populations. Travel bans rarely work.
No, but Dr. Pekos, would you go far enough to say they're actually hurting the message from the administration?
Yeah, I do think it muddles the message because, again, it takes us away from the primary goal, which is a difficult one to get across to people, as we've just talked about. But it really comes down to, here in the U.S., vaccinating people, and then going globally to make sure that the unvaccinated globally are getting vaccinated. All of those things are the primary goal and should still continue to be the primary goal.
Andy, on a Labor Day, with great respect for your academics, the fact is that technocracy has tried to speak in technocratic language to a part of the public that just can't deal with it. And my answer is you get Walker Hayes, who's got the #1 single in the country charts right now. You get him out there with a guy like you putting a needle in his arm saying, let's go. I mean, I just don't get where the celebrity oomph is to these people to say this thing isn't going to kill you.
I'll also add to that I think we need to take a much more personal level communication.
Fair. Yes.
The people that I've talked to on a one-on-one basis that are vaccine hesitant, it takes 15, 20 minutes sometimes of one-on-one conversations, but you can see people understand and start to realize what the benefits are of the vaccine and what the misinformation really is. I realize that's a very labor-intensive way to communicate, but it is probably the more effective way to communicate than trying to do these mass media campaigns and those types of things. It takes a lot more effort. It takes a real sort of sea change in terms of how we approach the communication, but I think that's the way that has shown some effectiveness.
Doctor, got to run. Got to leave it there. Thank you, sir. Dr. Andrew Pekosh of Johns Hopkins, the Bloomberg School of Public Health professor and virologist. Tom, you've been making that point for a long time. I'll give you that. In fact, through much of this year.
John, in London, in the United Kingdom, in the broader United Kingdom, are they taking head lice drugs for COVID?
I haven't seen that, Tom.
Yeah, exactly. It's not funny. It's like nuts.
It is nuts. Tom, there is a question as to whether it would make a difference if a celebrity actually came out and said what you'd like them to say. What celebrity would you like?
I'd start with President Trump. I thought it's a disgrace that he hid that he was vaccinated.
Okay, Tom, well, let's talk about that. Do you think there's a correlation between President Trump's supporters and their distrust of government? And do you think if the president actually told those supporters to go out and get the vaccine that it would make a difference? Because that's not why they support him.
Yeah, okay, I'll go there. But I'm on a Labor Day where we are, with all the challenges we got 82% vaccinated over 65 years old.
But that mistrust of government, Tom, is pervasive. It goes beyond just Trump supporters. It goes to minority groups as well. There is a genuine and in some places justified mistrust of government, and unfortunately, it has spilled into this conversation.
They're going to do it differently in Singapore. Look at the new headline, John. I'm sure you've got it on the Bloomberg terminal as well. I mean, this is a different cultural approach in Singapore, frankly, around the world.
And Italy said to be considering mandating the thing as well. So different countries will make different decisions on this, TK.
Absolutely.
Tom Keene, Lisa Ravis, Jonathan Ferro, your equity market looks like this.
I love his song.
0.2% on the S&P. Would you like to sing to break, Tom? Would you like to do that? What is the #1 country song right now?
I can't sing it. He's just got his voice is magical.
Too good. He's too good. Nice.
Nothing more.
That's a classic of yours.
Feeling.
From New York. This is Bloomberg.
Feelings of my feelings.
会場に行って観戦するということも難しいお子さんがいるんです。このように冷房の効いた本校の体育館の中で、それこそ大会の最前列で観戦ができる、体験ができる、こういうことをとても ありがたいことだなというふうに思っていますし、この技術に感動しています。予想以上に子どもたちの反応が良かったというのはですね、とても校長として嬉しく感じております。この子どもたち、どれだけオリンピックの心待ちにしていたのかっていったことがよくわかるような今日の表情です。
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What is making me really nervous today is that there is this accompanying surge in deaths as well.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Companies are navigating these once in a 500-year events, extraordinarily well. I think they'll continue to do so.
The consumer is very healthy. We're unburdened by debt. We're saving, and we have the demand. The demand is there.
There isn't really any pent-up demand in this economy.
The reality is it's not an economy moving to a new higher sustained level of growth. Nothing structural has really changed.
If one central bank is tightening further or more aggressively than another central bank, you should expect currency appreciation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Elisa Abramowitz. I'm Jonathan Farrow. Your equity market record highs into Friday. Equity futures up 8. We advanced 0.2%. TK, the payrolls report, 90 minutes away.
Payrolls report, we got to really focus on the many dynamics of it. I think Lisa was at the mentioned labor participation. Beneath the headline data, John, that's a number I'm going to watch. Do we actually get an improvement in labor participation? And frankly, we've got somebody coming up more than cautious.
TD looking for 400K. That's the low end of the range of estimates, Tom. And when it comes to the range of estimates, 1 million all the way down to 400, 725 the median. TK, we're just throwing darts at a dartboard here again.
It's a dartboard where you got to go. Is there a dartboard that does a 3-month moving average? I don't think so. John, I'm going to go to a 3-month moving average. And as Carl Riccadonna said, you know what? There is job formation, but for Lyle Brainerd, for Richard Clarida, for Jerome Powell, it's real simple. They've got to see more to get that 6, 8, even 10 million jobs employed.
For Jerome Powell, that's going to be the conversation we'll have here on Wall Street, Tom. You take the jobs print, the data point, then you have a conversation about what it means for the Fed. Lisa, let's talk about what it means for fiscal support. Senator Manchin, why I won't support spending another $3.5 trillion in the Wall Street Journal yesterday afternoon.
Strategic pause. They want to take a strategic pause to assess the inflation data, which I think is going to become the new transitory here as we try to parse through what they're looking for in terms of understanding inflation. And to that point, though, that's why I think that underneath the headline number, taking a look at the inflation, the wage inflation is going to be so important for the market reaction. If you see significant wage inflation, that may actually tie the Fed's hands more because it bleeds more into this view of a tight labor market rather than a lot of slack.
Tom, you wanted to make the point on the participation rate in the previous hour. Let's do that right now. For many people, that is the view that separates a hawk and a dove on the FOMC, their outlook for the participation rate in this labour market in this country.
What's called here is inertial force of a series. Jobless claims is gorgeous. It's got a massive persistency improvement every single week that we see it. You can't say that, John, about labor participation. It went down gloom, it came back, and it's flatlined. It's got to improve.
Reminiscent of what we saw several decades ago, Tom?
I think it's different now. I think the demographics are different. The service sector oomph is different. This technology overlay I wouldn't underscore. With Randall Crosner, I think those were important comments we had.
Let's get to the for this market. Record highs into Friday. Your equity market shaping up as follows. Equity futures up 8, advancing 0.2% Thank you, Tom. I think that's about 0.15% on your lovely, beloved Dow.
Nailed it.
I know I'm warming up to you just a little bit. It's taken a number of years. Yields higher by about a basis point of 10, 129.37. I'm not sure how many people would call me sensitive, Tom. In the FX market, euro dollar 118.72. Elisa, unchanged in the FX market on a euro.
Yeah, although I will note that there actually has been a huge surge of cash out of cash funds and into risk markets. So people ahead of this market, ahead of this payrolls report, are expecting something that will be good news. Unclear, though, whether that's a good report or a bad report. 8:30 a.m., we do get that jobless report that you were talking about, that payrolls report for the month of August. You both were talking about the participation rate and how important this is to both the Federal Reserve as well as to market participants' expectations for how they will respond. If you see, actually, it's declined and it stayed down from that 63.4 pre-pandemic. We're still down at only 61.8%. Why does Lael Brainard keep talking about 8 million people who are out of the labor force? Why are they out of the labor force, and will they come back? 10 a.m., we get the U.S. ISM Services Index for the month of August. How much has the Delta variant really weighed on the resurgence of the services sector? This really has flatlined, and this has been a concern for many people because without the services sector, we are reliant on a manufacturing sector that hinges much more on some of these supply chain disruptions that we keep hearing about. And then 10 a.m., President Biden is going to speak on the jobs report. Very curious to hear how he responds to Senator Joe Manchin from West Virginia. John, you were talking about that op-ed, taking a look at one graph in particular where he was saying a pause is warranted because it will provide more clarity on the trajectory of the pandemic, and it will allow us to determine whether inflation is transitory or not. I do wonder, substantial pause, if that is the new transitory, John.
How long does that pause need to be?
Yeah.
Lisa, I think you asked the right question in the previous hour, and we'll ask that question again a little bit later this morning when we catch up with our Washington correspondent, Anne-Marie Hordern, in around about 15 minutes. Let's catch up with Priya Misra, TD Securities Global Head of Rate Strategy, joins us now. Priya, 400K at TD. Let's start right there. Why 400K, Priya?
So we knew reopening was never going to be a straight line. It was hard to extrapolate from the last two very strong prints, but really the high frequency data that we're tracking suggests a pretty sharp deceleration in the leisure and hospitality sector. So sort of extrapolating from this high frequency data, it's not a horrible report, but yes, relative to the last couple of months, I think relative to what the Fed would want to see to taper in September, I think it is a weaker number.
Priya, the media, we're guilty of this as well. We love to look at equity guesstimates out 12 months and make a parlor game of the Standard & Poor's 500. We don't do it as much on the 10-year yield. What is your adjustment on your yield call out 12 months?
So we're looking for a higher rate call, not necessarily for today because we are looking for a weaker number. But, when we think about over the next year, we do expect the Fed to taper. We expect the economy to continue to recover. The household sector is strong, the corporate sector is strong, and then we expect more fiscal stimulus. So, that should mean higher rates. I think my end point of that hiking cycle, the end point of how high long-term rates could go, that's a little bit lower than consensus forecast.
Well, give me a number. Come on, nobody's watching or listening. Give me a number.
2% by the end of next year. Oh, so, it is higher from here, but it's not, I don't know if you're getting 3-4%. So we just need structural changes to happen.
Priya, you talk about how you're on the low end of the spectrum, but does that also include with wages? And this is important because a lot of people are looking for clues as to whether this is a tight labor market or one that has a lot of slack based on just how quickly wages are going up. How closely are you watching that?
We're watching it extremely closely. I don't know if you'll get a whole lot in today's number, though, because it's still August. Schools haven't opened. We're in the midst of a Delta surge. So, and we still have the supplemental unemployment insurance out there for many states. I think the next couple of months, assuming the Delta surge has peaked, at least the COVID fears go away, schools reopen, and as the supplemental insurance goes away, we actually expect people to come back to the labor force. Maybe not pre-COVID labor force participation, because there have been structural changes in the labor market, but certainly higher from here, and that's going to keep wage inflation low for now.
That's the September data that we won't see until next month. Priya, let's talk about this bond market a little bit more. Looking for 2% on 10s at the end of next year. Can you help us understand whether this market responds a little bit more, say, to a weaker number than, say, a stronger number a little bit later this morning, and how you'd push that through this yield curve?
Sure. So I think the market has been hoping for higher rates all year. And so I think the pain trade is still lower rates, but we're near the lower end of the range. Where I think it's more interesting is the curve. The curve has flattened significantly. It's almost the market saying the Fed is exiting no matter what, and the economy is slowing. And I think what Chair Powell tried very hard last week to tell us is, well, they're going to start to taper, but the hike has a high bar. And so we actually think that hiking probability or timing can be pushed out further. So that should steepen out the yield curve. So I think the first hike can move to late 2023. We're not looking for, even though we're looking for a taper to begin at the end of this year, we're not looking for the first hike well into 2023.
Interesting, Tom.
Right.
John, pick up on that. That's a huge statement by Priya there,
Priya, that's going to be a big communication effort for the chairman.
I'll say.
He can say that himself. Do you think he can get the others on board?
It's all going to come down to the data, really. I think the Fed is going to try very hard to separate the two. But if inflation remains very high, if it feeds through into service inflation, I think that's a key component, not just goods inflation. If wage inflation starts to pick up, I think it's going to be very hard for them to push out hikes. But our view is that service inflation is going to stay low. There's still a lot of slack in the labor market. And so if we're into next year and we realize the Fed's tapering, but inflation's decelerating, well, that hike then looks well into 23.
Priya, absolutely brilliant. Maybe spend more time with us and less on John Farrow's properties as well. Priya Misra, TDO.
Isn't this one of mine as well?
Appearing on The Real Yield occasionally as well.
I have some ownership of this too.
Thank you. But John,
Priya, thank you.
I can't do anything with my collar. It came out when I was coming down the stairs.
Go on.
John, this is important. Priya goes to the heart of it. She's talking about a 10-year yield out to 2% at some point. And then we bring that over to what does it do to the Dow Jones Industrial Average if you go to a 2% yield?
Well, United Health is about 8% of your beloved Dow Industrial Average, Tom. So you tell me what it does to United Health and to Goldman Sachs, and I'll tell you what it does to that index.
Let's go to the S&P 500 there.
Let's
what
go
does
to the
it do?
S&P instead. That's
okay,
right.
Let's do that,
Let's
please.
go there. Now, do you want to equal weight that, or do you want to market cap weight it?
I'd go value line geometric, but continue.
Let's go based on the traditional market cap weighted S&P 500.
Let's do that.
We won't equal weight it. We'll have a look at tech, and tech is a major component of that. And if you ever move towards 2% on 10s, Tom, you'd think that would disrupt mega cap tech, wouldn't you?
Yes.
You'd think that may help the financials, the small caps, etc.
But that's not enough to push against the gigatech.
No. Does that go some way to answering your question?
I thought it was very good. Lisa, you want to jump in here? I mean, I'm sorry the two are linked.
I think that the problem is it's very hard to talk about any of these without talking about how we get there, right? Because there are different scenarios where we could get to a steeper yield curve, where we could get to potentially a rate hike. And how we get there really matters as to the performance of the equity market. For example, if you do see that there is less slack in the market than the Fed thinks, and a lot of economists think, all of a sudden you get wage pressure, that could be actually kind of negative for a lot of the S&P. And that, I think, is something people are looking at, whereas some natural growth will be positive. I mean, honestly, John, the uncertainty about that sort of feature, the dynamics under the hood, interesting.
Yeah, I agree. If it's inflation driving 10s through 2% and a Fed that becomes overwhelmed, that could be pretty toxic for everyone involved. Your equity market this morning up 0.2% on the S&P.
Nice quote.
Thanks, Tom.
John, an
Appreciate
Apple correction is a 135.
Is that right?
Yeah, Apple correction, 135.
Would you like to tell the audience about your walk down 50 flights of stairs this morning?
No, I cleared the mind.
Up. I like it.
I do too.
What was great is at the 20th floor, they had a tang break. They had a little cardboard
They've
table
got a
out
desk for the people that make the walk down the steps.
He's on Prosecco now.
That's a high-end building, Tom. Tank waiting for you at the bottom. From New York this morning, it's Payroll's Friday. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. A surprise announcement from Tokyo. Japan's Prime Minister Yoshihide Suga says he will resign after failing to control the coronavirus surge. That leaves the ruling Liberal Democratic Party scrambling to find a new leader weeks before a general election. Whoever becomes party leader is virtually assured of becoming Prime Minister because of the party's majority in Parliament. Suga's been Prime Minister for almost exactly a year. In New Zealand, a man described as a known extremist and terrorist attacked people with a knife in a supermarket before being shot dead by police. The attack happened in Auckland. Prime Minister Jacinda Ardern said the man was a Sri Lankan national. 6 people were wounded, 3 seriously. Investors will be watching at today's U.S. jobs report for the latest read on the health of the labor market. According to a Bloomberg survey of economists, the U.S. probably added 725,000 jobs in August. That's a more moderate pace compared to each of the last 2 months, but risks related to the Delta variant could mean a softer than expected number. The jobs report is out at 8:30 a.m. New York time. And brace yourself for a flashback from the 70s. The hit-making Swedish group ABBA is reuniting and coming out with its first studio album in almost 40 years. ABBA gave us hits like Dancing Queen and Waterloo, not to mention the Broadway musical Mamma Mia, which became a hit movie. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This week on Bloomberg Green, how will the world's biggest polluter wean itself off of fossil fuels? We map out China's journey to net zero with one of the country's leading environmentalists.
We did see some great progress made in terms of local pollution control.
Protecting the Great Green Wall. A forest holding back the spread of the Gobi Desert is in danger of being cut down and creating a schism between China's central and local governments.
There's sort of a balance that they're trying to win. Because there's a climate diplomacy on one side, while on the other side, they very clearly have some economic goals and needs.
And the dark side of clean energy. A crucial component of solar panels is being produced in secretive factories in Xinjiang. Our reporters went to find out what was inside.
Any company that's active in Xinjiang is cooperating with the regime there.
I'm Kaylee Lyons in New York, and don't miss this week's edition of Bloomberg Green on TV, Quick Take, and online.
The July jobs report was strong.
This is an across-the-board favorable report.
More money, more hours, and more people working.
Wages up.
We're seeing our economy moving forward.
Unemployment down.
The unemployment rate declines by 0.5%.
But will Delta hit the brakes on the momentum?
We could still see the consumer become a little bit more skittish.
A lot of kind of negative surprises focused really on the Delta variant.
Tune in for the August jobs report, Friday on Bloomberg Television and Radio.
What we're seeing now is in the era of climate change with this extreme weather event, even the higher elevations are experiencing this flash flooding. So we're going to attack that even more. The big problem is when the street drainage and the sewer infrastructure gets overwhelmed, gravity takes water into the subway system.
It has been a tough time for much of this country over the last month, and for New York City included. That was Jano Lieber there, the MTA acting chairman and CEO. From New York City this morning, good morning, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. It is Payrolls Friday, 7.25 is the estimate. Your equity market looks like this, up 0.2% on the S&P, yields are higher by about a basis point. Your 10-year yield, 129.37. Crude bank with a 70 handle, $70.07. And in the FX market, TK, just to round it out, euro dollar unchanged, 118.71.
Right now in the politics of the moment, I've been really focused on the moderates, those close elections around the country, and of course the character of the moderate from West Virginia as well. Anne-Marie Horton has spent some quality time looking at the progressives as well, and as there are conservatives that win 83% of the vote. Anne-Marie, I would note Pramila Jayapal from the People's Republic of Seattle wins 83% of the vote in the last time around. Now, she went after a Bloomberg story yesterday, is leader of the Progressive Caucus, basically is the leader of the liberal voice in the House. What's she upset about?
She quote tweeted our story about Joe Manchin and said, quote, absolutely not. And this was, of course, to Senator Manchin's opinion piece in the Wall Street Journal talking about the fact that he wants to take a strategic pause on the reconciliation discussions and that he will not vote for anything close to $3.5 trillion.
Okay, well, let's look at the tweet here. This is from the gentlelady from the Bronx, of course, on the same tag team as Congresswoman Jayapal. I thank you, Emery. I don't know what I do without you.
Tom, about the People's Republic of Seattle.
The senator from West
Seattle.
I ignored it. I know, good job.
The senator from West Virginia has weekly huddles with Exxon and is one of the many senators who gives lobbyists their pen to write so-called bipartisan fossil fuel bills. It's killing people. Our people, at least 12 last night, sick of this bipartisan corruption. I had to walk down my building today, Anne-Marie, because of Exxon. It was their fault. Anne-Marie Horton, how quickly are these people making Speaker Pelosi the minority leader?
It's a very good question, Tom. And historically, a first-term president, that first election after that, there's always like a referendum. And the talk is, of course, that potentially they will lose the House or potentially the Senate. But really, it's hard to see what voters will care about next year. And depending on what this slim majority, but majority of Democrats can deliver. I will say to Congresswoman Alexandria Ocasio-Cortez in her tweet, we must remember who Senator Joe Manchin is and what he represents. This is an individual from coal country, West Virginia. It is a state that President Donald Trump carried very strongly, only second. I think it was the strongest, best state, second only to Wyoming. He has a fine line to walk as well. And he did vote for the process for this $3.5 trillion to go through. Doesn't mean they'll get $3.5 trillion. He potentially wanted to see those markups. He voted for that to be done by September 15th. I think the question is, why does he want it to take a strategic pause now? And if there is a pause, does this mean that hard infrastructure that has wide bipartisan support, does that mean that's on hold as well?
Well, that's where I wanted to go. This idea of where are the bend points here for both factions within the Democratic Party. The idea of progressives taking a pretty hard line on one side and saying it's a no-go if you're not going to consider our $3.5 trillion plan. And Senator Manchin saying we need infrastructure, but why don't we put that on hold before we have a better sense of the economy? Who's going to bend?
It's a very good question. It's going to be a tit for tat for weeks on end, and we'll just be sifting through all of his tweets, opinion pieces, interviews every single day. The one thing I do come back to is the fact that the Democrats know that they do have potentially a very hard midterm election next year. This is their moment in time to get this economic agenda through, and will they squander it or not? That is the big question. But the progressives are using that as leverage to make sure the likes of Joe Manchin do not back down on that $3.5 trillion. But no one thinks it's going to be $3.5 trillion. Potentially, this is Senator Manchin just making it very clear, black and white in the Wall Street Journal, that that is something he will just not support, to make sure he has that leverage. The other question, though, is he's worried about inflation. We heard him pen a letter to the Fed earlier this month as well, but also about the federal debt. But the Democrats come back and say, but we're raising taxes for this. This is not going to be like we're having to use all of this financial tools and debt to do this. There's a lot of questions that remain, but I think this is really him just making out his point that they need to come down much lower on that reconciliation
Worth
package.
pointing out, we're working on the assumption that the Democrats get hurt in the midterms, but let's continue that conversation. What would hurt them, Anne-Marie? Would it be the progressives? Would it be the moderates? And I asked this of Jack Fitzpatrick in the previous hour. Is it what this party, this administration, this government will do, or ultimately what it won't do that will hurt it the most?
I heard Jack's answer, and I like that. I think what he said was what would hurt them in both ways. Like he said, if they do child tax credits, but then they don't extend it, then that could potentially hurt them. You have to take the mood of the nation next year. Right now, the president's polls are suffering, and a lot of this has to do with what's going on in Afghanistan. But that is not likely going to be the key topic November 2022.
What I'd observe, John, is that Jack got up earlier than
I noticed that. I noticed that.
I don't.
I'm dragging Anne-Marie to the US Open tomorrow, Tom.
Oh, yeah?
Dragging her there and making her buy the drinks.
Really?
Yeah.
It's going to happen.
He
Anne-Marie
got
back in New York.
courtside tickets. I couldn't say no.
Yeah.
You're paying for them. Anne-Marie Hordern down in Washington, D.C. I'm watching the correspondent.
Cheers.
Jamie, my producer.
I'll
quickly turn the page on
Yeah,
this.
exactly.
I'm
We're
not
talking about
paying
the
for
markets
them.
now.
Jamie, my producer, just pinged over Dan Ives of Wedbush very quickly. Tom, so let me bring you that note he just published.
Please.
Apple to 3 trillion market cap for Cupertino in the next 6 to 12 months. Just reiterating his view on the stock. The stock's done nicely more recently. We maintain our outperform rating and $185 price target. So no surprise to many this morning, Tom, that the equity market bulls are still bullish.
I'm speechless, John. John, I just set a record. I've got an Apple thingy in every room of the house.
Yeah, even for Vet Bell.
That's why Dan Ives, that's where he did his research.
Just to put that into perspective, the current market cap is just north of $2.5 trillion.
Yeah.
So it's another $500 billion get tacked on in the next 9 to 12 months.
You know, John, we make jokes about extrapolation, but Ives has been rocking it. I mean, he's just killed it for
Big
3
time.
years.
But big tech, Tom, up until recently, hadn't done a lot for many people this year. Amazon still hasn't done a lot year to date. It's been the likes of Alphabet and Facebook that have really turned up.
They got a new CEO. People are sweating Jesse. That's all.
You think that's what it is?
Yeah, I do. They did the same thing with Cook. OMG, Steve Jobs, Tim Cook. It's not going to work. Jeff Bezos out. New guy. It's going to fail.
Can I ask a question? Honestly, is Amazon.com still a tech company? Given how much hardware and how much personnel they have to get in, do they count among the big giants that don't have to employ that many people and count on their software and their hardware?
It's a good question, and the answer is they're a different kind of tech company. What do they got? Like an air fleet, John, like British Air?
Something like that, Tom.
Yeah.
Or at least they will do. Tom Keane, Lisa Bravis, Jonathan Ferro, your equity market futures
They
up
wanted to use the
0.2
Gulfstream this
of
weekend.
1% on the S&P. Your bond market, 129.37. You're tied by a basis point. 1 hour and 5 minutes away from payrolls. The median estimate this morning, 725K. On radio, on TV, this is Bloomberg.
what do you predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City on TV and radio, this is Bloomberg Surveillance, a little bit like herding cats on a daily basis, and no difference on Payroll's Friday. Lisa, not aimed at you. Nothing that same down. Equity futures up 0.2% on the S&P, on the Nasdaq at 26. Was that a cap?
That was a cap.
0.2% on the small caps up a third.
Anne-Marie's going to the Open. Anne-Marie's going to the U.S. Open, and Lisa and I are twiddling our thumbs.
Pretending to
Do you want to come with me? Are you upset about that?
How can you see me at the U.S. Open?
I can see you cramped into those little seats, TK. Let's get to the bond market. Switch up the board. 2s, 5s, and 10s. I want to talk about 2s, 5s, and 10s. Your 5-year, 77 basis points. A little bit earlier this morning, in fact, about 20 minutes ago, we caught up with Priya Misra of TD Securities. You've got to make 2 guesses on Payrolls Friday if you're in the market. You've got to guess, 1, the jobs number, and then 2, how the market responds to the jobs number. And you've got to think about, will we get a bigger reaction to a miss or a bigger reaction to a beat? And Priya Misra of TD, they're looking for 400K, and they think there's some asymmetric risk around this. They see a bigger move off a weaker number than a bigger than expected number, and they see it being pushed through the yield curve in a very particular way. So let's talk about that. Switch up the board and get to the yield curve. And we'll talk about 2s, 10s, but maybe you're better off talking about 5s, 30s, whatever, take your pick. 2s, 10s right now, just south of 110 basis points, Tom. Over the last year, up about 58, but over the last 6 months, we've started to close that gap again, that spread between 2s and 10s. And the reason they see this asymmetric risk, they believe that a weaker number will enable the Fed to even more aggressively de-link that messaging around tapering from interest rate hikes. And if they can push out that hike a little bit more, you get what's called maybe a bull steepener. So a steeper curve, but driven by rate hikes being pushed out the front end and through the belly, Tom. And I think that's interesting. That's just a view from TD and something to think about as we approach these numbers. 1, what is the number? And 2, how does the market respond to it?
It's going to keep a lot of people busy. To me, John, it's about data dependency as well. I want to link it into something we haven't mentioned this morning, folks, and that's oil. Rounded up, we had almost $74 Brent crude, and this has been a little bit of an oomph here in commodities through the week as well. So with oil up, West Texas Intermediate, $70.17 a barrel. That folds into the interest rate story that'll be key here in about 58 minutes, I should say. On individual securities, Romain Bostic.
Yeah, taking a look at those individual securities. Keep an eye on some of the software companies. MongoDB, the database software company, a beat and raise quarter here across the board. The CEO making some very bullish comments about visibility going forward. Morgan Stanley and Piper Sandler raising their price targets here on the company. Those shares up 14%, also in the software space, and up 14% pre-market. That's PagerDuty, the IT software company, also guiding slightly higher here, but more importantly now, that reoccurring revenue growth now back to pre-pandemic levels here. A big shift in the company, which had been relying on smaller customers as CEO. She's been making a pretty big pivot to larger corporate clients, and that appears to be paying off. Those shares having a pretty good day here. And keep an eye on Broadcom. They actually reported earnings here. Revenue came in at about 16% growth rate. That's well below what their competitors are doing, like Qualcomm and NVIDIA, which are posting 60% plus growth rates. But Hock Tan, the CEO, said on the conference call, this is actually deliberate, that they're actually trying to constrain some of their sales now to avoid a glut in the future, basically saying they'd rather sacrifice it now to kind of smooth things out going forward. Investors, I guess, seem to be buying it. Those shares up about 0.8% here in the pre-market. Flip up the board, Chinese ADR still under pressure. Alibaba down slightly here in the pre-market on those regulatory concerns. VIP shop, those are down here on the downgrade over at UBS. Yeah, Tom.
With what we see with Didi and Didi up a little bit right now, what's the institutional ownership in America of all these names?
Well, for Didi, it's much smaller. Obviously, Baba, you're talking about 20, 30% here. For Didi, I'm not exactly sure what the percentage is. Obviously, a lot of this has to do with the potential state control of the company. That report by Bloomberg that the municipal government in Beijing is going to be taking a pretty sizable stake here. I'm not exactly sure why that would lead to a 4% rise in the shares. ADR is pre-market here, but some people seem to think that at least this might put some of the regulatory issues to bed, and that Didi can now just go forward with whatever the business model is going to be.
Romain Bostic, thank you so much. It is always important on Jobs Day to speak to the chief economist, Ellen Zentner, with Morgan Stanley, their chief U.S. economist. It is ever more important today on the American labor economy in her GDP call that stopped global Wall Street yesterday morning. Ellen Zentner joins us now on Jobs. Ellen, let's do the labor economy first. We just had a very cautious call from TD Securities. What is your non-farm payroll statistic?
Well, Tom, so it's not that exciting. It's 725, which appears to be right in line with consensus on Bloomberg Terminal. That's why I say it's not exciting, because we put exciting in quotes because a miss to the upside or downside is what gets us really excited.
Yeah. Well, when we see the statistics now, I want you to fold them into the uncertainty you have of an August slowdown. I mean, this labor report, the labor report for September that we'll see first week of October, how do you adjust those given your new GDP call?
So basically, you have to disconnect the two. So we've made a very sharp mark down to growth in the third quarter. It was pretty much solidified when the motor vehicle sales came in yesterday, fourth consecutive decline, big drawdown from pulling demand forward when we got the stimulus checks that last round back in March. And so basically, this is not a jobs story. It's a payback or demand that was pulled forward due to the stimulus. So we're moving further and further with that in the rearview mirror. And then ongoing supply constraints. And so the bulk of the jobs that we're bringing back are in the service sector. And that I would view as disconnected from this story that over the summer, we've hit a slow point or low point for growth in the economy. Today will be a number to watch closely. September and October, which Chair Powell has said he's most focused on, is also very important. We're looking for labor force participation rates to rise.
Ellen, just to be clear here, the 4Q number for you guys, you and a team at Morgan Stanley, which you lead, was unchanged. I'm trying to understand from your perspective, do you have confidence about 4Q? Is it just too early to really make the call to make the change?
Well, I think that, we focus most on third quarter tracking. And of course, what we expect for those final months in the third quarter does set the base effect or set the momentum, if you will, the ramp going into the fourth quarter. And our motor vehicle analysts believe that August motor vehicle sales was the low point. There's other data that we think was also the low point as well. That big payback that we saw in consumer confidence because of Delta concerns, because of rising inflation. Well, on a month-over-month basis, those inflation numbers are slowing. Delta has peaked. And so probably we get a bounce back in confidence in September. They're expecting motor vehicle sales to start picking up again in September and going into the fourth quarter. So that will be a critical factor to watch. If there's one sector to really watch to see if we're still confident in our fourth quarter numbers, it will be those motor vehicle sales.
Well, let's build on that then. How would you characterize it then, Ellen? Recovery delayed or recovery derailed?
So I would say payback came early, front-loaded, if you will. We've been forecasting a sharp slowdown in growth in the second half of the year, but we had expected it to be more broad-based across the second half, more spread out. Instead, it looks like the payback has been fast and furious and been front loaded into the third quarter. And that's why largely fourth quarter remains intact. You're still going to get slower growth for the year. The Fed is going to have to bow to this in their next forecast update and mark down growth. But it's not so surprising that momentum is slowed. It's just surprising that it's all been lumped into this quarter.
Ellen, in one way, you actually do agree with a more bearish call, perhaps, or a bit softer labor market than others, because you did look at wages and expect them to come in softer than expected in terms of how much they increased. And I'm wondering how this plays into your view of a tight or a loose labor market. And this really does feature into, are we delaying the recovery or are we derailing it? Because if you are seeing the slack sort of just become a scar, that will be a difficult thing to overcome. So which is it?
Yeah, so describing slack as a scar on the economy is a great way to put it, Lisa. And so if you look at wages, you know, this monthly wage number, the average hourly earnings that people tend to focus on most, is quite fraught with a lot of volatility and it's very difficult to measure. So we're bringing back a lot of service sector jobs. That tends to put a heavier weight on this particular measure. And we had an upside seasonal bias in the last month, and that comes out in this month. So we have to take a broader look at the wage picture. Wage pressures are there and they are rising. But that is why we've got such a strong increase in labor income, which is important to offset some of the fading fiscal stimulus. But the labor force participation rate, you've hit the nail on the head. That is the most important thing to watch. It's the bump in labor supply that's coming that Chair Powell and the Fed are watching. And it's got to improve, or else you do start to wonder about how many jobs have just been lost permanently. We think about 2/3 of the jobs lost during COVID can come back. That means 1/3 of them, which is a significant amount, are permanently lost.
Wow.
So it's not all warm and fuzzy on the labor market, but we are continuing to see gains, and that's getting us closer to the time that the Fed will start to taper.
Ellen, we're lucky to catch up with you on Payrolls Friday. We appreciate it. Thank you. Ellen Zentner there of Morgan Stanley, the chief US economist on the forward look. And we've talked so much this morning about the forward look and how your view ultimately on the Federal Reserve, Tom, separating the doves from the super doves right now. It's your forward look on participation, on the participation rate in America.
These things are really important. I learned this from Robert Goodman, who was the chief economist at Putnam Investments for years. There's all sorts of other ratios, Johns, and jobs away from the media fixation on non-farm payrolls and obviously the U3 unemployment rate. And these things with a denominator in them, like labor participation or percent employed in America, these are really important ratios.
Let's not let that slide, though. 1/3 of those jobs, Lisa, permanently lost.
That's what I'm stuck on. The idea that 2/3 will come back, 1/3 won't. That is significant. And really, where did those people go? Is it early retirements? Is it just bowing out of the labor force? And how is the Fed policy really going to address that?
Well, does that fit into the view of Chairman Powell right now?
Yeah, I think that it does, which is the whole slack in the economy and the fact that basically, you know, you're going to have
You think they believe that 1/3 are gone? You think they believe that 1/3 of those job losses are permanent?
Well, here's the thing. So, well, we could discuss this. But if 1/3 are gone, does that mean higher wages or not?
It could mean the labour market's tighter than they think it is.
It could be.
Tom Key.
See the tone she had?
Lisa
We can
Bramlage.
discuss this.
Well, no, it's a bigger point.
Let me
That's
translate
my
that.
point.
Anne-Marie's going to the open, Lisa's not. Okay, that's it. We can discuss this.
You're very jealous about this.
We can discuss this.
You can come with me if you like. I'll get an extra seat.
We can discuss
All you had
Bill-
to do was say.
He'll bill Anne-Marie.
Come on.
We can discuss.
Up 8 on the S&P. We're up 0.2%. We'll discuss in the break. Yields are higher by a basis point
discuss this.
at 129.20. Your estimate shifting just a little bit higher into payroll. 733 now. Your median estimate in our survey. From New York, this is Bloomberg.
With the first world news, I'm Ruchika Gupta. The race to succeed Japan's Prime Minister Yoshihide Suga is seen as wide open. In a surprise announcement, Suga said he would resign after failing to control the country's coronavirus surge. It's just weeks before the general election. Whoever becomes the next leader of Suga's Democratic Party is virtually assured of becoming Prime Minister because of the party's dominance in Parliament. It's a tax settlement that is one of the biggest in the U.S. history. The billionaire founder of quant hedge fund manager Renaissance Technologies and his colleagues will pay billions in back taxes, interest, and penalties to resolve the case. Senate investigators pegged the amount at a minimum of $6.8 billion. The case has to do with the way the firm converted short-term gains into long-term profits. New York and New Jersey learned that the old norms of weather no longer apply. The remnants of a hurricane that first hit New Orleans killed more people in the northeast than it did on the Gulf Coast. At least 40 people in the region died from floodwaters caused by torrential rains. Airports and commuter trains struggled to resume service. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could tank the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
We're on a long transformation program within China where the creation of wealth, and it's about definition of wealth, it's not super wealth just, it's wealth for the middle class and it's wealth for the urbanization that's taken place. That's why I think everyone's interested in China as an opportunity for wealth.
A tough seat for Noel Quinn, the HSBC CEO, when he has to answer questions about China right now. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bramvis, I'm Jonathan Ferro. Catch that full interview with Francine Lacqua through the weekend on Bloomberg. Your equity market futures positive 0.2% on the S&P, advancing around about 8 points. Your bond market yields higher by almost a basis point to 129.20. Payroll's just around the corner. The report 42 minutes away. The estimate 733,000 now, just a little bit of a tick high going into the print. Tom Keene, we need a guest to translate this particular headline. Shanghai suspends the key approval on the route to offshore listings. A ton of confusion around that story over the last couple of months.
It is constant. There's no question about it, including Bloomberg reporting today on Didi in Beijing. Enda Curran joins us now in his late Friday evening. We're thrilled that he could take time to join us, our chief Asia correspondent. John's got 5 questions, Enda, here in our 1-hour conversation. You and I know the sound of the Hong Kong trolley right by the HSBC building in Hong Kong. It's charming. The tourists love it. Francine Lacqua interviews the gentleman from HSBC. In your world right now, how is HSBC and Western banking, how have they changed given this new information flow out of Beijing?
I think they're having to adjust, Tom, pretty quickly. We are in the middle of a pretty serious policy blitz. Like you mentioned there at the start, we're getting an announcement almost every day, and it's all about more control and more oversight, more regulation coming out of Beijing, whether it's control of personal data, whether it's tackling the big technology sector or online education. The authorities are deadly serious about pushing through this agenda now, which they say is all about, of course, driving equality, common prosperity and a more equal society. So foreign businesses are getting caught up on that, and I think the view among many is that they have to take it as face value that Beijing means business.
And they're just trying to understand the news that's just come out just moments ago from our team here at Bloomberg. I'm trying to make this really simple. If Alibaba wanted to go public today, could they, in America?
Well, it's pretty complicated because of the greater oversight now that they're putting on these listings that want to go overseas, John, right? They have to get special permission because it's all about data control. China doesn't want that data going overseas. This is the whole story about ADRs going offshore, for example. So the thinking is that these Chinese companies will now have to list at home and raise capital at home, and that's why Hong Kong becomes an option, Shanghai to some extent. So I think it just, again, it fits this whole idea of more control, more oversight, more regulation, and the idea that Chinese companies will be able to pick up and go overseas and raise foreign capital and do as they wish in the past. Well, that's just an idea that's now gone.
And when we ask these questions of individuals like the HSB CEO, it's a tough seat for them to be outspoken. I think it's a tough seat for anyone to answer these questions right now, including you, sir. So I have a ton of respect for your reporting that you're doing. And I'll ask you the following question, and it's a difficult one to answer, granted. What are we seeing right now? Just ongoing reforms, Enda, or something much, much bigger than that? Some kind of cultural revolution?
Well, there's no doubt we are in, kind of an era of the government in Beijing pushing through these very strict changes to oversight and control of the economy, Jonathan. And on the one hand, there's a policy agenda there that is all about, pushing through and making life cheaper for families, for example, to grow the population. That's a key priority. There's certainly oversight of the technology and financial sector that they could argue is justified. But again, of course, on the other side of the ledger, there's no doubt that this does also go to political control and more control from the centre and more control from the party. They're making clear that the government is in charge, that the Communist Party remains in charge of everything. They say what goes, they say what the economy can do. And I think that's the way we need to take it at the moment. It's face value. The party's in charge, and it's not going to change.
And to build on what John was talking about, there are these economic concerns and these economic regulations and credos. And then there's this commentary published in the state-backed newspaper basically saying that the cultural market will no longer be a paradise for sissy stars, and news and public opinion will no longer be in a position worshiping Western culture. How much of this type of crackdown do you feel on the ground in Hong Kong? How much is this being received as a shot across the bow in a more fundamental way?
Oh, there's no doubt about it, Lisa. There's certainly a crackdown ongoing in Hong Kong when it comes to political expression or the right to gather or to push the pro-democracy movement, for example. All of that has been crushed by the authorities, no question about it. And you're seeing some of that tension spill over from the mainland, and what we're seeing now is a ramping up of that rhetoric. I mean, some of it isn't new. There's always been kind of warnings against vulgarity in the press, but this idea of cracking down on the celebrities, like I mentioned, this goes to the broader crackdown on the education sector, and don't forget the new rules on gaming, for example, and all of that goes to the idea that China wants to produce a more productive and more effective, useful workforce. So there's no doubt that this language is very confronting and different to the Western era, but this is how China wants to go about doing its business.
And you're a gent, and we appreciate your time, sir, especially late into the Friday evening with you and Karen there, Bloomberg's chief Asia economics correspondent, Anna Hong Kong. Lisa, what a difficult moment.
It is such a difficult moment because this crackdown goes so far beyond just sort of a communist referendum and the idea of trying to get more equality. There is something else here, too, in the tone, John.
Something we've got to stay on top on. Tom, another headline you're looking at, I know, Germany declaring Japan a high-risk COVID-19 area.
Well, we saw it after Singapore, and you wonder maybe with Labor Day and the shutdown at 8:32 this morning that everybody's rushing out headlines this morning. You've got Germany looking at Japan. You've got Singapore, it seems, constraining things, ramping up their booster program, and then off the crisis in New York City. And I really want to emphasize to people, even though it's sunny out, there's still a crisis in New York City. The mayor says we'll have to use travel bans during weather events. He's doing that over with Joe and Mika right now.
Assuming, Tom, we're going to see a lot more of what we've seen this week.
Yeah, well, I think it is first of all, it was a really unusual August. Ellen Zentner highlighted that with auto sales and the rest, and it leads you into what is September going to be like? I mean, the uncertainty here, John, is tangible into this jobs report.
Tom Keene, Lisa Bramis, Jonathan Ferro, your jobs report coming up in around about 35 minutes' time. Your equity market up 7 points, advancing 0.15%. Yields higher by a basis point on 10s to 129.37. Heard on radio, seen on TV for our audience worldwide. It's Payroll's Friday, and this is Bloomberg.
I'm Andrew Krasny with an exclusive U.S. Open update for Bloomberg TV and radio from Tennis Channel. Novak Djokovic is one step closer to making history at Flushing Meadows after reaching the third round. The world number one took out Holland's Talon Griekspoor in straight sets to leave him just 5 wins away from completing the calendar slam. Djokovic is looking to become the first man since Rod Laver in 1969 to win all 4 majors in the same year. He can overtake Roger Federer and Rafael Nadal in the all-time list at the Slams if he wins his 21st title in the Big Apple. 12 aces and 32 winners for the Serb, who moves on to face Kei Nishikori for a spot in the round of 16. And don't forget, you can watch all the action from Flushing Meadows every night on Tennis Channel. I'm Andrew Krasny.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies are navigating these once-in-a-500-year events, extraordinarily well. I think they'll continue to do so.
The consumer is very healthy. We're unburdened by debt. We're saving, and we have the demand. The demand is there.
There isn't really any pent-up demand in this economy.
The reality is it's not an economy moving to a new higher sustained level of growth. Nothing structural has really changed.
If one central bank is tightening further or more aggressively than another central bank, you should expect currency appreciation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs Day in America, on radio, on television, across this nation, around the world. It's just another jobs report. But, John, I'm sorry, there's something different this September 3rd.
Let's go through the numbers, Tom. 733, that's the estimate. 400K, that's the low from TD. $1 million, that's the high from UBS. And there's just a belief, Tom, that whatever this print is in 30 minutes' time, it sets the tone for the Federal Reserve decision on September 22nd.
I'll go with the Fed thing, but to me, it's much more about the gaming of the of GDP of America. Alan Zentner stopped the world with a 2.9% Q3 statistic. If you have a 3% American economy, John, how do you add jobs?
Tom, I'd add to that. Demand has been great. Saw it in the ISM. Supply side has been the issue. That is where the story is right now. And that is why September, not the August data, was so crucial for so many people. Would we start to see labor supply match the demand we've got in this country? Because demand is absolutely stellar. Tom, you might have to wait for it. Because in August, there were still some problems.
Alan Zentner joining us, making clear it was about the auto industry and a number of other sectors as well. Lisa, that comes down to the 1, the 2, the 5, the 6 Americas that are out there. Which one are you focused on?
The 1/3 of jobs that she said are not coming back that were lost. And I'm trying to actually think about John Farrow's question to me, which was an incredibly good one. And frankly, the answer is not clear. How does the Fed read that? Does that confirm the Fed's position that there's a lot of slack in the labor market? Or does it not confirm that because those jobs are not coming back? And so all of these jobs that are open don't have people to fill them. I don't know the answer, Tom. I mean, that's the thing. The uncertainty of this economy that's been fast forwarded is just incredible.
I want to get to our guest, John. I want to get through this quickly. But, John, to me, the observation from Randall Krosner, the former governor, Carl Weinberg watching this morning, emailing in, they all say the same thing. The technology mystery of the American labor economy is profound.
Something we need to work through, Tom. Got to work through this market too. Equity futures TK up 6, advancing a little more than a tenth of 1% on the S&P. In the bond market, yields higher, surging by a basis point on a 10-year to 129.20. In and around 130, Tom. We talked about that earlier this week, didn't we? We've set up a new camp in and around 130 on a US 10-year.
Widely anticipated, our guest in this hour to talk the markets, not the economy. Jonathan Golub joins us with Credit Suisse, their equity strategist, setting the world note here, 4 or 5 weeks ago with 5,000 SPX going out well into 2022. John Golub, do you stick by that optimism?
I do, but there is a really big disconnect between the economics, which are coming in weaker because of supply chain issues and COVID issues, and corporate profits, which are coming in much stronger than anticipated. And you talk about two labor markets or two Americas. There's really, from where we see it, there's the economy and then there's corporate profits, and they don't look like each other.
John, you've talked about how corporate profits have been tremendous by this market, by cyclicals, and you've pushed back against people calling for a more nuanced approach. Can you talk to us about that and why you just want to grab hold of this market in any way you can?
Well, I mean, first of all, what you have is this really strange translation between, the way corporations behave versus the way the overall economy does. So, first of all, when inflation...
Hello, traders. I'm going to place an order to sell short British pound. Okay, the price I'm looking to sell 138.314. Okay, if you're looking to trade British pound, here is your chance. Place an order to sell. Stay with me, and I will guide you through this trade until the end, until we will close this trade in profit. Okay? Stay safe.
And tech is doing perfectly fine, but it's just not doing better than it was a year ago on a relative growth basis.
John, has the Federal Reserve severed the market in some ways as a reaction function to the economy? And I say this because you're talking about the differential here from weakening economic data and even better earnings expectations that are coming out. How do we understand this? What breaks that link or that lack of link?
Well, Lisa, you made the comment, a little while ago on this disconnect between the number of people saying they want to find a job and the number of jobs available. And so it doesn't appear that it's a lack of demand for labor. Companies will tell you that they have a demand for more labor. There's a mismatch. The number of retirees over the last couple of years, people moving, things of that nature because of pandemic. So it really looks like this is not only a supply chain disruption where companies can't get their parts. There's just a broad-based disruption from the pandemic, and it's very difficult for the Fed or policymakers or strategists or economists to figure out why the data doesn't seem to make as much sense as it should.
John Golub, I want to go to the heart of the matter, which is you absolutely nailed, frankly, like no one else, the call this year. I put you and Ben Laidler together with just simply getting it right. And part of that was don't sell tech, have patience. The gigatechs continue to go up. Ives over at Wedbush guys, Apple 185 today. I don't want you to do an individual stock, but update us on the gigatechs and their support here into 2022 and 2023.
Well, it's interesting, Tom, that if you separate out the story between kind of fundamentals and the backdrop, the fundamentals are much stronger for the cyclical part of the economy. However, when interest rates fall, and so when interest rates fell from 175.
Okay, guys, position opened at 138.314. It's short position. Stay with me, all of you guys who managed to enter position and who managed to purchase contract. Well done. Stay with me, and I will let you know what's going to happen next with this contract. Okay? Speak to you later.
Go on.
Yeah, no. I mean, the story is that the disruption that we're seeing in the economy is going to last much longer than we all think. And when people are asking about whether inflation is transitory, it's the wrong question. Is the disruption from the pandemic and the reopening process transitory? And the answer is yes, as long as you think transitory is 1 or 2 years. And if that happens, as much as it may be vexing for the Fed, it's really good for corporate profits because companies have figured out how to manage this and turn it into better profits. And better profits are what's driving the market, not sentiment, not easy money. It's this incredible profit growth.
Okay, John. So to quote Kit Jukes over at SocGen, how long can this Goldilocksian environment persist for equities?
Well, first of all, I don't think that I would describe this as Goldilocksian. I mean, the whole economy is broken. I mean, we can't find the labor we want, and there's disruption, and you can't order the car that
but stocks are up. That's what you meant.
But stocks being up and Goldilocks are not the same thing. But how long do stocks stay up? If the Fed doesn't do something dumb, I don't see, which they're not going to. I mean, they just won't. This thing is going to continue longer than we think. And the disruption that we see in the labor market that you talked about is not going to disrupt the stock market. So I think the next year is going to be another very strong one. When we put out that 5,000 number, Tom, and it seems so aggressive, now with how much the market's moved since August, it perhaps doesn't seem strong enough, given how.
Do you want to come on? You want to make some news here? Let's go. We had, we had 5,050. Come on, let's go. 5,100.
You did this to yourself, John.
How Pollyanna we were about things a month ago when we put out this number, and today everyone is nodding that this seems, quite doable.
That sounded like an upgrade. We'll take it, John.
No.
Jonathan Golub, now in trouble with the rest of the team over at Credit Suisse, the chief US equity strategist and head of quantitative research. John, thank you. John talked about how this labour market was broken. Let's dig into that. This was the quote from the team here at Bloomberg when they looked at the small business survey from NFIB, the data that they put out, Tom. 50% of firms had job openings they could not fill last month, up 1 percentage point from July, and the largest share in monthly data going all the way back to 1986, a record 41% of small businesses and their owners said they raised compensation. So comp is up, openings are up, and there is a problem filling those openings, Tom.
Yeah, to me, John, it permeates every discussion I have. Every single contact I have with society is they're looking for jobs. There's no other way to put it.
Looking for jobs, and Tom, the higher comp is getting it done.
Yeah.
Is it 15, 16, 17, 20?
No, the trend is that we don't know. No, we don't know is my answer. I've been right on this. 15, 17, target today, $20, something somewhere. Have we found where that level is yet? I don't think we have.
Lisa, have we?
I wonder if the overall average wage increases that we see in the average data really captures what you're talking about. The sort of increase in the lower wage earners, basically that income is seeing a much bigger increase, and it's disproportionate. It's evened out by the people who aren't seeing as big of an increase on the other end. And I wonder if that's not being caught by the data and doesn't necessarily reflect the tightness that perhaps is existing in these specific sectors that might push those wages even higher.
Go on, CK.
Well, 19 minutes away from the jobs report. To me, it's a big deal, and the reason we can do this, John, is the support we have, including the good folks at the Tennis Channel. I want everybody to know you could see Farrow and Horder watch them on the Tennis Channel this weekend on radio, on TV. It will be a sight to see.
Thanks for the promo.
Where are you going to be, Tom?
Where will you be?
Reading summer reading with afterthought.
Summer reading, lovely.
It's romantic as all get
You're
out.
very upset about this.
I am.
I have to say. I'll get you a seat if you want a seat.
Do I have to wear tennis whites?
Yes, yes, you do.
Who pays?
I'd love to see that.
Who's going to pay?
If he wears tennis whites, I will. Equity futures up 5 on the S&P. Anne-Marie will. Up a little more than 1/10% on the S&P from New York this morning. Good morning. Your payrolls report, 18 minutes away. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Progressive groups are calling for a big lobbying effort on President Biden's $3.5 trillion spending and tax plan. They demand that Democrats in Congress avoid any compromise. Their quest took on more urgency after Democratic Senator Joe Manchin called for what he said was a strategic pause in action on the Biden economic agenda. A surprise announcement from Tokyo. Japan's Prime Minister Yoshihide Suga says he will resign after failing to control the coronavirus surge. That leaves the ruling Liberal Democratic Party scrambling to find a new leader weeks before a general election. Whoever becomes party leader is virtually assured of becoming prime minister because of the party's majority in parliament. Suga has been prime minister for almost exactly a year. In New Zealand, a man described as known as extremist and terrorist attacked people with a knife in a supermarket before being shot dead by police. The attack happened in Auckland. Prime Minister Jacinda Ardern said the man was a Sri Lankan national. 6 people were wounded, 3 seriously. In China, President Xi Jinping ordered sweeping action to clean up the entertainment industry. The country's broadcast regulator is moving to ban film stars with, quote, incorrect politics, limit salaries, and rein in celebrity fan culture. The regulator says that those actors who are divided in heart and spirit from the Communist Party and the country must not be used. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at Frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When you look at people's behavior and you see that they're quitting in very large numbers, and you see a lot of job openings, that suggests to me a pretty tight labor market. We're also seeing a lot of wage pressure. Then the key for the Fed is that wage pressure going to turn into significant inflation, which gets back to the productivity issue.
The View from Randall Croson there, the University of Chicago Booth School of Business professor. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Your equity market going into payrolls is positive, up 7 points, advancing 0.15%. Yields are higher by a basis point to 129.54. Your FX market, euro dollar unchanged, 118.75. The print, 12 minutes away. Tom Keene, the median estimate, 733K.
We will look at the statistics. We'll go beneath the headline data. But what John, Lisa, and I love to do is look at the social aspects of this labor economy. It is a tradition with James Glassman, J.P. Morgan Chase, an understanding of the American labor economy right down to its very fiber. Jim Glassman, good morning to you. Jim, I want to devote time here to the theory of trickle-up wages. A lot of people go against this. The idea of $15, $17, Target advertising $20 this morning. Does that trickle up through the wage hierarchy?
It appears to be, and I hear this a lot from my clients who are complaining about having to compete with Amazon and those folks. So I think this is really a challenge at the lower end. I think the need for workers is really beginning to pull people up. And, you know, there are limits to how far this goes, because small businesses have to worry about, can I pass this on in prices? I don't think they feel they can. There's some can, some can't. And that's really the ultimate limit, is what we consumers are willing to pay.
How does technology overlay into this? If there are price takers and small business price makers, how do they have trickle up wages and yet maintain profit? I don't understand that.
You know, what's interesting is more and more people are realizing this is probably a structural problem, and it's making them think harder about innovation. I hear this story a lot, and they think it's going to be good for workers, because if you bring a robot into the manufacturing site, you need people to manage that thing and understand it, and it starts to upgrade the level of skills. And they think it's going to be attractive for workers. So this is the way it should work. When you're innovating and you be able to boost productivity, you may have fewer people, but you ought to be able to do the same thing and pay people more.
Well, Jim, and this goes into some of the price increases that we keep seeing at the likes of Walmart and CVS and Walgreens, and we keep seeing it day after day, and yet we look at the average hourly earnings and they've only increased about 4% year over year. What are the averages not capturing that we're seeing in the anecdotal data?
You know, I think the big wave that the averages don't tell you, when you have a major demographic shift that's going on right now where 65-year-olds are retiring and 22-year-olds are coming in. Young workers may know a lot more about technology than the old guy, but they don't have the same life skills, and so they're not paid the same. So I have a feeling it's this demographic thing that may be dampening the whole shift in wages. We hear people saying I'm having to pay more for specific jobs, but my guess is when you look at the averages, this demographic thing is masking what's really happening.
Jim, just real quick here, do you think that this labor market is tighter than it seems, or still has a lot of slack the way that the Fed is saying?
I think it's got a lot of slack. 7.5 million jobs below where we would have been had there been no pandemic, and half those folks left the market, but they probably will be back in. Honestly, I think there's so many dislocations. It may feel tight because you can't get people in the right spot, but I think there's a lot of work to do.
On the Pulse of America, Jim Glassman, thank you so much. A great tradition with J.P. Morgan. John?
We need to get to the host of the main event. It's Michael McKee, our economics editor. He joins us ahead of that payroll report. Mike McKee, 733K. That's the median estimate. What should we be looking for in around about 8 minutes' time?
That's exactly it, John. This is going to be the more consequential jobs report than we've seen in quite some time. And it's really going to revolve around that headline number. The way Wall Street is setting up, anything under 600,000 is going to be seen as a problem and delaying Fed action. Anything over 1 million might pull everything forward into September. So keep an eye on that headline.
I thought last month was most consequential. What's so special now?
This is the month that several Fed officials identified as the data they wanted to see, the September
payroll. Well, give us some names,
report.
Like who?
Chris Waller was the first to mention it. Rob Kaplan has talked about it. Others saying we wanted the September number because it's the August number because it is the last one they'll get before the September meeting.
Mike, what's more important, the headline number or the amount that wages have increased?
The headline number is going to be the most important to Wall Street, and the Fed has got to parse out what the effects are that are impacting the wages. Is it a compositional effect because lower wage people are getting jobs, or is it because companies are paying up to get people back to work? That's a little harder to tease out, and they'll be looking at things like the employment cost index later on to try to get more information on the pay levels.
Mike, you're fantastic at cutting through the stupidity of the conversations we have on a daily basis. What are we talking about here? The September report or the August report, and tapering by what? 5 to 10 billion, either October, November, perhaps into December. What is it, Mike?
Well, the theory right now is that the Fed comes out at the September meeting and says we are going to announce tapering soon, which then everybody will price into November or December, and they can look at the October payrolls report and see what happens. The idea that we get a big payrolls number could force them to announce a taper. The market could push them to announce a taper at the September 22nd meeting. And of course, if we get a really poor number, they push that back maybe to November or December.
They have a labor mandate, but has it been overwhelmed by this modern fiscal experiment where the labor mandate, they can talk it all they want, but it's really not part of the discussion?
Well, it's part of the discussion. What they're trying to do is bring down not just, they're trying to redefine what maximum employment is, which is the mandate. It is
well,
not,
give us a number to
just
3
number.
What's maximum employment off the unemployment rate right now to 3 decimal
Well, we got to 3.5% in February of 2020 without any kind of inflation. The long-term forecast by the Fed is that you could have 4% That takes into account maybe a smaller labor force, but it is also they want to bring down the black unemployment rate, which was down in the 5s before we saw the pandemic begin. So they're trying to make it a broader definition of what it is.
Mike McKee, thank you. Sticking with us.
He's going to stay with us. Good.
Bases loaded going into payrolls, Tom. Do you like that? It's a baseball reference. Equity futures up 7 on
Red
the
Sox are winning
S&P.
again.
On the data, Michael McKee in around about 5 minutes' time, alongside Tom Keene, Lisa Bravitz, Jonathan Ferro. This is Bloomberg Surveillance with your equity market at record highs going into Friday and adding some weight to that rally, up by 0.16% on S&P 500 futures this morning. Your 10-year yield up just a single basis point.
This is so exciting.
We've been hanging out in and around 130 over the past week since Chairman Powell spoke. This time last week, your 10-year yield 129.37, euro dollar unchanged at 118.71. Your estimate 733,000. The range is wide, wide, wide. At the low end, it's 400K at TD. At the high end, it's 1 million at UBS. On radio, on TV, the payrolls report is next. This is Bloomberg.
China has been focused for a long time now on catching up to the United States in space when it comes to space exploration, and they've really made a couple of really impressive achievements. For instance, in May, China landed a rover on the surface of Mars. It's only the second country after the United States to manage to do that. In June, China sent astronauts to its space station, which is still under construction. China is not part of the International Space Station because the United States worked to exclude China from that. But instead, the Chinese are working on their own. That's scheduled to be in full operation, I think, next year. The Chinese have really come a long way in space. That said, all of that's run by the Chinese government. There is a role for Chinese companies to play in the space program. They're not being as front and center, say, as Elon Musk with SpaceX or Jeff Bezos with Blue Origin. China's companies are playing a more supportive role, I think it would be a fair way to say it, working on things like satellites, rocket launch operations. They're leaving the really big, sexier items when it comes to space exploration, leaving those to the Chinese government.
The power of Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market?
There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early starts to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, we see the evidence of that strong consumer.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The payrolls report is seconds away, live from New York City, heard on radio, seen on TV. This is Bloomberg Surveillance with your equity market pushing higher. Futures up 0.2% on the S&P 500. Yields higher by a single basis point. Here's the number, a big downside surprise. Here's Mike McKee.
Back because it's only 235,000 jobs were created in the month of August. The unemployment rate does decline by 0.2% to 5.2% as forecast, but that is a really, really dismal number, much lower than the lowest forecast that we had in the Bloomberg survey of economists. The unemployment rate at 5.2% reflects 8.4 million people who are unemployed. That is a lower number, significantly lower than it had been, but there don't seem to be a lot of people gaining jobs, and it's kind of hard to tell why. A lot of concern about the COVID variant in the month of August. It was early in August, the 12th, the week that includes the 12th, that they do these payroll reports, surveys, but maybe it did have an impact. Private payrolls, 243,000. Manufacturing payrolls up to 37,000. That's 10,000 more. Well, let me back up. That is less than the 52,000 revised manufacturing payrolls. Because let me go back to the top here, John. 235,000 jobs created. The July number was revised up to 1,053,000 from 943,000. More than that's 110,000 additional in the month of July. So that takes some of the sting out of it. But it doesn't fix everything.
And the math on that, John, is 369,235 plus 134.
Mike, you take a deeper dive. Let's go through the price action. Some subtle moves off the back of this. Equity futures are fading a little bit, up just 2 points now. They were up 0.2%. In the bond market, a subtle shift as well. What you're seeing here is a move at the front end through the belly. Yields lower by about a basis point or so. This is exactly what Priya Misra was looking for, Tom Keene. The so-called bull steepener, the front end rallying just a little bit more than the long end off the back of a weaker than expected print. The idea being that maybe the Federal Reserve can just push out, massage the message a little bit, that they push out any conversation about rate hikes anytime soon. And Tom, just quickly, let me finish with the FX market. Dollar fading, dollar weaker, off by about 1/3 right now. A break of 92 on dollar index.
We're thinking together, John. We do this once a month. John and I actually on the same page. Euro 119 really gets my attention, maybe, of what we're looking for in September. Starting with the fact that Priya Misra nailed it, John. And John, let me go to you as you observe this, as Mike reads in on this voluminous report. What I really see here is this is a jobs report that is extremely Fed-centric. It's not about the labor nuance. It is about what Chairman Powell is going to do to adapt and adjust.
For many people, it sets the tone for September 22nd, and perhaps it helps the chairman push back against the Hawks just a little bit more. We can have that conversation right now. Mike McKee, 235, massive downside surprise. Let's translate what this all means for that conversation on the 22nd.
Well, it probably means that the Fed is going to sit back and say, we want to see more data at this point and see if this was a COVID-caused anomaly. The average hourly earnings went up significantly, 0.6%, pushing up the annual rate to 4.3% from 4.1% in July. But that may be a function of who got hired, because I'm looking at the breakdown of jobs here, and employment in leisure and hospitality, unchanged. That's been the area that has seen the most job growth. Decline of 42,000 jobs, Tom, in eating and drinking places.
So what does that signal?
It signals that for some reason people were not being hired because they weren't out there looking for work, or because these restaurants and bars were not looking for people because they couldn't staff up given the pandemic situation. We won't know, but the anecdotal reports is what the Fed's going to be looking for there. Let me just note quickly, Lisa, 61.7%, no change in the labor force participation rate.
Okay, so there's no change in the participation rate. There was, though, an increase, a much bigger than expected increase in wages. What are you looking for to understand how broad-based this is versus something that's just compositional in terms of the jobs that were created in the month?
It's going to be very hard to tease that out. The folks with models and automated Excel spreadsheets can maybe look at which categories added the most jobs compared to the change in wages in those categories. But we really don't know. I mean, we can guess when you see a number like this and you see that eating and drinking places were down 42,000, leisure and hospitality, no change at all. The people who get the lower wages that would have pulled that down were probably not in the labor force, not adding to this, whereas professional business services, higher wage people coming back into the labor force adds more to the wage growth.
Michael McKee's going to read it on this. This is a report much more nuanced, interesting than I thought, and he'll be on with us through the morning here to give important perspective. John Farrow, to me, the NASDAQ 100 speaks massive bond volume. This is a NASDAQ jump up away from what we're seeing in SPX and Dow because they're settling in on a lower rate regime.
Starting to see things change at the long end of the curve, though, Tom. So let's have a look at that and push through that 235, that big downside surprise on a payrolls report against an estimate of 733. Yields higher on 30s now by about 3 basis points, on 10s by 2. However way you chop this up right now, there is a view on the September the 22nd meeting that number will just anchor the hawks a little bit and stop them flying away and causing too much trouble for Chairman Powell. Let's bring in Jeff Rosenberg on that of BlackRock's portfolio manager. Jeff, I want to start straight there, sir, with a downside surprise and your first interpretation, your first read.
Yeah, the first read is definitely this has some Delta variant on it. The mix shift here is retail's lower. Leisure and hospitality, which had been contributing, 400, 500,000, doesn't show up at all. The wage increase that you guys were talking about, that really looks like a mix shift here. And the disappointment is in those two sectors, and particularly leisure and hospitality, which speaks to, potentially this Delta variant impact. Now, because that's the fingerprints, that's a temporary impact. And John, as you just highlighted, the initial bond market reaction was lower yields, but now you're starting to kind of push higher in the back end. To me, that says the market's looking through this and seeing, hey, this is temporary. We talk about transitory inflation. We're going to talk about transitory Delta variant impact here, at least with regards to the market reaction. And, a little bit of disappointment as well in terms of the labor force participation rate not budging. Again, I think that's more of a temporary factor related to the Delta variant. So I think, the market was already, pushing back in terms of expectations of when the tapering announcement would happen. This solidifies that in terms of the folks who were expecting something sooner, or the hawkish viewpoint. We'll get another month. Everyone will look for that, look for the Delta variant, hopefully, to come out of the September and even the October reports as we wait into later this year for the tapering announcement.
Governor Brain has been on the money here for many people. Wait for the September data. Wait to see if the supply side of this economy will heal. Do you think they have the luxury of time on their side to wait for that?
They do, in the sense that, they're really going to be focused on the longer term implications. And, they have talked over and over about the necessity, particularly Powell's speech last week, the need not to react and overreact to short-term developments. And so, from that vantage point, they don't need to rush into it. And the most important thing not to lose sight of here is the emphasis that tapering is not tightening. And once we get past this tapering announcement and they go on kind of an autopilot of each monthly reduction, then we're going to shift this conversation, and it's going to be about, well, what does this do to the path of future tightening? But that path of future tightening doesn't begin until maybe late in 2022. So they've got a lot of time here before we get to that.
How important is the revision upward for the prior month? The idea that it was revised from 943,000 to more than 1 million. The idea that there was momentum and that perhaps this blip really is just a pause due to the Delta variant.
It's a good point, Lisa, and that's another part of this report. It reinforces how strong the labor market was going into this Delta variant impact, and I think that may be what the market is looking through. that this is a one-off slowdown and not the beginning of a new trend, and that the strength in the labor markets will reemerge as the reopening recovers.
Equity futures just fading a little bit here, Tom. Unchanged on the S&P 500, basically unchanged to negative on the Nasdaq now. I'll be catching up with Rick Reeder, Jeff's colleague, at the top of the hour, alongside Anastasia Amoroso and Mike Collins. We'll do that on the open, Tom, in about 20 minutes' time.
Sounds good. Lots to talk about there as well. I just did the 3-month moving average of where we are with the double revisions, and I think away from the gloom of the moment, folks, this is a pleasant survive. Jeff Rosenberg, 2250 jobs over 90 days, and that comes out to 750,000 exactly per month. I'm sorry, Jeff Rosenberg, that's not a bad number.
Not bad at all. And you're reinforcing the broader point, which is if you look through the noise, this is a very strong labor market, good recovery. Is there more room to go? Sure. And that's what some of the points many of the more dovish members have been highlighting. And that's, I think, the broader takeaway is that the reopening is happening, the recovery in the economy. The thing that this isn't talking about and that the Fed is also going to be concerned about, and I think our focus will shift towards, is the impact of fiscal policy. We're going to have a fiscal tightening, even with a $3.5 trillion stimulus plan. That is not the same kind of stimulus as the stimulus that is rolling off. That's long-term stimulus over a 10-year period. And so the Fed's going to be concerned about the impact on economic growth of that fiscal tightening.
Are you managing then 12 months forward, 24 months forward to a 3% American economy or something? We're getting back to where potential GDP is. Is that your overlay here as you manage bond money?
That is, Tom, and it's in most of the longer run forecasts. We've had an incredibly impactful impact on short-term growth from the combination of reopening and historic amounts of fiscal stimulus. That's going to roll off. And so what is really the underlying debate or the overriding debate is what's the underlying capacity of the economy and the strength of the economy and its ability to deliver. And most of the consensus views have you going back to that level. And the concerns on the downside is that you'll press even lower. And that's the argument against moving too quickly and overreacting to what might be transitory impacts on inflation. Now, of course, the other side of the argument is that we've done some serious structural damage to inflation expectations, the supply chain. The Fed has admitted, they've underestimated the degree and length of how long the restart economics would impact on the supply side. And so all that, that's the growth side. But it's also the inflation side.
Some interpretation here is markets reverse. NASDAQ 100 with a spike up earlier comes right back around to a modestly negative statistic. The VIX out to a 16.53. Lisa, the 10-year yield, higher now, 1.31%.
Yeah, it seems like people are looking past the huge headline miss. And to really reiterate what Jeff was saying, they're looking more at the upward revisions. They're looking more at the momentum heading into what was a Delta-packed month that really saw zero net jobs in the travel, leisure, and hospitality sectors, which is really shocking given where we are in the reopening. But Jeff, this really goes to the question, is the Fed getting this right? And does this data confirm that basically there is a lot of slack in the market? Or are we starting to get some concern with respect to the wage data, albeit you have to parse through it?
Honestly, it's too early to know. There's a lot of critique on both sides of the debate as to whether the Fed is making mistakes or not. One obvious concern is there is a tremendous amount of inflation, but it's not in goods and services prices. It's in assets, and you see it everywhere. And it's the asset inflation and the financial stability concerns. It's in the minutes. There are folks who are concerned about it. If that ultimately shows up in a negative way, then the argument will be, oh, the Fed missed it. But given what we know today, it's hard to argue that is the case right now. And so the Fed's focused on what's right in front of them, which is they don't feel the need to, move preemptively. And that's the change in flexible average inflation targeting. So they're going to be reactive. And that's the kind of Fed response function that we now live with.
Jeffrey Rosenberg, thank you so much. With BlackRock, there's the systematic multi-strategy fund. Michael McKee looking over the data. Carl Weinberg emails in with a great vector observation. Mike McKee, 750,000 jobs a month. That gets you out in 8 months. We get a true job recovery. Are we just being too impatient? I mean, the fact is Weinberg goes out 8 months. The rest of us are looking out 1 week or 8 hours. Well, the answer is we got to have a longer term perspective.
What's driving everybody's views on this is the bond market, because the bond market is reacting to what they think the Fed is going to do in terms of tapering. And does tapering matter? Not that much to the overall economy. They'll still be stimulating, but the $120 billion a month isn't doing anything right now to increase jobs. So that focus is perhaps a little misplaced. Now, 235,000 would have been average during the pre-pandemic period. We would have said, it's not a bad report.
Have you ever seen a central bank so ex post, so data dependent to wait and wait and wait and wait?
Well, we really haven't seen it because this is a new reaction function for the Fed. They changed their the way they look at things, and they want to run the economy a little hot and pull inflation up and pull unemployment down. And we'll see how that experiment goes. Without a lot of jobs here, comparatively not a lot of jobs here, how does the Fed react to that?
Mike, I'm looking at the participation rate. The fact that it did not budge is really disheartening. The fact that we're still at 61.7% from a pre-pandemic high of 63.4%. Where did these jobs go if they are not coming back? If Ellen Zentner is right that a third of all jobs lost during the pandemic will not be resurrected?
Well, a certain amount of them are jobs, places that went out of business, retail stores, restaurants, bars that couldn't maintain through that period. A certain amount of it may be that people have retired out of work, and the companies are either unable to find somebody or they're automating the jobs so that they don't need to replace people. This is going to be a project for the economists who write papers for NBER for quite some time to tease through all this.
And this is something that Tom's been talking about all morning, this sort of automation and the technological revolution that's been happening. But using what we just heard from Jeff Rosenberg of BlackRock, this idea that the Fed is really data dependent and we don't understand the data. The data has been a mystery. Is the Fed getting increasingly subject to shocking markets should the data shock us in a way that perhaps we're not getting right? Because clearly we missed this.
Yes, that is very possible, but the problem is we won't know it until we have some history behind it and we have some time to look back and see where exactly we went wrong in anticipating what was going to happen and how this all comes together. And the problem is, of course, the traders on the bond desk have to do something right now. So the economics and the trading function don't match up exactly. It'll be interesting to see, and I've got to go back up in the report here for just a second, because it'll be interesting to see what the Fed thinks of this in terms of the fact that we didn't get a lot of jobs, but we did see the unemployment rate drop a lot. And I'm just looking here to see if I can find the different categories for that. The unemployment rate for Black Americans is down a full percentage point, or actually, no, I'm sorry, it goes up. It was at 8.2, goes up to 8.8. So in that case, the Fed is going to say, well, even though national unemployment went down, we didn't get a good number for the minority unemployment that we're looking to try to improve.
And Michael McKee, thank you so much, and much more from Mr. McKee through the morning. I would note CIBC up in Toronto makes a careful note that higher paying categories were where we saw the jobs gain.
Which is huge. That's really interesting, because then we can't necessarily extrapolate too much from the higher than expected wage increase.
It's a social issue. And
it's a compositional issue.
Yeah, I can do that as well. Pleased to tell you, Priya Misra, we hope, scheduled to join us here in a number of minutes. Ira Jersey right now, Bloomberg Intelligence on rate strategy. What does the bond market say this morning, oh wise one?
Hey, Tom. The market's saying that they think there's going to be more fiscal stimulus, and maybe the Treasury Department isn't going to cut coupons quite as much as some people thought. I think that's one of the reasons why you're seeing this knee-jerk reaction to the market be steepening, with the long end yields going up a little bit. Interestingly, look at the very front end. Look at what's being priced into interest rate hikes. So we're actually priced about 6% of an interest rate hike out of 2022 and 2023 instruments right now. So this number basically is saying we're going to get more fiscal stimulus. We're going to get, maybe the Fed is still going to taper. That's certainly what the long end's telling you. And then the short end is saying they're not going to hike for a little while. So this is really a recipe for running hot and steepening of the yield curve.
Ira, do you think that this jobs report takes a September taper announcement off the table?
Yeah, I think it probably does. I mean, they'll couch it, and we'll wind up hearing Chair Powell say something about, we're still looking into it. We'd like to taper. It's appropriate to do so. But I still think, and this doesn't change our mind at all, I still think November is when they're going to announce it, and they'll start it basically right away, because they'll announce it the first Wednesday of the month, and then the next week they'll start to cut their purchases.
Too short a visit, Ira Jersey. Thank you so much. On the equity markets, Gina Martin-Adams, our chief equity strategist. Gina, corporations have to adjust off of this. How will they?
I think they're going to really think about their costs. What we saw in this report was our six monthly stretch of average hourly earnings gains. As the economy is starting to slow, we're not seeing too much easing in cost pressures, and the result of that is analyst estimates for margins into the second half of this year are starting to fall. Analysts have some confidence that this is temporary, and that margin compression that we see in the second half of this year as revenues slowed down, but cost pressures remain somewhat high, that's supposed to be somewhat temporary or transitory, and we'll see margins go higher into 2022. But I think companies, in order to get that margin gain into 2022, are really going to have to think carefully about their cost structure and their operating environment, because we are seeing costs maintain a higher level than I think many companies are comfortable with.
Gina, we've been talking with people who view this economic report from the bond lens. Let's look at it from the equity lens in terms of what companies see in terms of slack in the labor market, in terms of just how hard it's going to be and how expensive it will be for them to hire workers. When you see a labor force participation rate that stays the same at the suppressed rate, and when you see this low number of jobs created, and you hear about all these job openings, what is the inference? That there's a lot of slack, or that perhaps things are tighter than people are saying?
I think it's just, frankly, there's a lot of volatility is the real inference, and it's very industry specific. You're seeing wage gains in specific industries certainly outpace many people's expectations. You're seeing a lot of volatility in the labor force. I think, frankly, the fact that this is August and it's pre-school starting in September is also playing into this. We have yet to really get our kids back into school to ease the tension in the labor force to allow their parents to get back to work. We're starting to see a little bit of that, but at the same time, we're seeing revenue growth slow as a result of the Delta variant and some slowdown in economic activity. So frankly, the real story here is volatility. There's no one big story that you can paint out of this report. I think it's industry by industry.
Sure.
But in general, company costs are higher than they would like to see. And that, as a bigger theme, I think is going to continue to play out over the next couple of quarters.
Gina, just to put a bow on this, do you think that traders are adequately pricing in the margin pressures that we're going to see in the next quarter?
I think they're pricing in margin pressures being temporary. In the next quarter, probably. If margin pressures continue into 2022, absolutely not. The anticipation, again, by traders, by the market at large, is that all of this inflation pressure is very temporary. It'll ultimately go away. The risk is that it's not, and that's certainly not priced in stocks.
Gina, thank you so much. Gina Martin-Adams with us with Bloomberg Intelligence this morning. Any number of people publishing. Dr. L. Arian of the University of Cambridge publishes now and speaks of stagflationary winds that we may see here coming up. Right now, victory lap, and folks, in the game of economics, it's awfully tough to do this. We suggested surveillance at 369,000. 235 plus a revision. That is the new 400,000 Priya Misra absolutely nailed the call today. Priya, it's 750,000 jobs per month over the last 90 days. How will that affect the Powell calculus?
Hi, Tom. Thanks for having me back. So, yes, it's a weaker report, but if you look at the 3-month moving average or look at the other data, it's suggesting that the recovery is continuing. It's going to be in fits and starts. The reopening we knew was not going to be in a straight line. So we think tapering is still very much on the table. But we're calling for a December taper, not a September taper. I mean, November is possible if the next couple of reports are very strong. But later this year, they taper, and then we see inflation next year. We don't think they're hiking well until the end of 2023. So that's why I think the curve is steepening today.
Just to be clear, Priya, are you actually pushing back your expectation for the start of taper to December today based on this report?
No, we've been calling for December because we were looking for a weak report today.
So just looking forward, Priya, what are you going to be looking for to get a sense of just how quickly they could potentially readjust their expectations? I mean, we know that wages are somewhat skewed by compositional issues, but are there other aspects that have you concerned, like the labor participation rate?
Exactly. So I think labor participation is a key one, particularly for the next couple of reports, because we know the supplemental unemployment insurance is running out. We know that schools are reopening. So we're really hopeful that people re-enter the labor force. And that's going to tell the Fed, particularly the doves on the Fed, I think will feel vindicated that there is a lot of slack in the labor market. And until wage inflation properly picks up, not because of compositional effects, which is what we think held the number up, or has been for the last few months, when it's true underlying wage inflation picks up, that's when I think some of that transitory narrative falls off. Yeah. So that's really going to be key the next few months.
We need to give a very careful shout out to James O'Sullivan as well. Jim O'Sullivan, working with Priya Misra, is doing all the heavy lifting here. Priya, when you talk to Jim O'Sullivan about Q4, what do you argue about?
So we argue a lot about the pace of deceleration. Jim's had a great call on the number today. Are we decelerating from a 7% first half GDP to a 3-4%? And what's the next step? Are we going down to 1% or 2%? And, Jim is in the camp that things are decelerating. Reopening is fading. The fiscal stimulus impact is fading. But growth is still solid and well above potential, which will allow the Fed to exit. It's just the inflation question where Jim has a slower, or a slowdown in inflation. So that's a key part of extent of deceleration and what's the longer-term impact on inflation. Those are the big questions.
Link your bond world, your full faith and credit world, to the equity markets. We don't do that. We do that clumsily, I would say, within the media. Does the yield mystery now support equities or create greater uncertainty for equities?
I think, I don't think there's such a big disconnect between the two. I think the Fed is telling us they're tapering, but very slowly. The end point of the hiking cycle, the market has taken down that number significantly. Yep. If the Fed's only hiking to 1.5%, that's a very bullish environment for risk assets. So I'm less concerned about the Fed aspect. I'm more concerned if global growth slows down. Then that is something that the bond market is somewhat priced for, but the equity market's not. So I see it more as a growth concern rather than a Fed concern.
Priya, one final question. Tell me about the x-axis duration here of all these moves that we're going to see. I mean, I know we go out to December on taper, but do you begin to really extend out yield angst, if I can, to the middle of 2020, if not later?
In terms of when we think rates will rise?
Yeah, when price down, rates up.
Right. So I think it also depends on the fiscal side. Do we get a 3.5 or 2 trillion, or if Senator Manchin's saying nothing without an offset, how much of the offsets are we going to get? I think that's a key component as well. But if the Fed starts to taper, there's a lot of supply that the market has to take down. So I think a gradual rate rise, starting at the end of the year, continuing next year, I can see that consistent with tapering.
Priya, to you and Jim O'Sullivan, congratulations on just simply doing market economics. We greatly appreciate your return this morning. To be clear here, 235,000 plus the revisions get you right out near the TD Securities number. We'll give them a victory lap. There's a few others out there always that, and then there's others that got it wrong. Speaking of getting it wrong, Michael McKee joins us here with $1 Million Club as well. It goes back and forth, but the bottom line is if you're away from the middle, it's dangerous. It's a tough business.
Well, it's always dangerous, but now it's really hard because, you know, there's so much we don't know about this. So you give Jim O'Sullivan 400,000. He was the low guess or low forecast. We don't say he guessed. And give him credit. Give him credit for that. But, he was looking at a set of factors that other people weren't looking at.
I have 8 more questions. I have no time. I mean, we got to talk wages, productivity, Red Sox pitching.
The good news is Bloomberg TV's on all day.
It is on all day. Michael McKee with much more perspective through the day. Please stay with us on television and radio. This is Bloomberg. Have a great Labor Day.
A big downside surprise on a payrolls report live from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, more fuel for the Fed debate.
This is when the rubber meets the road because
the payrolls report.
What matters is the strength of the labor markets.
The stronger the jobs report.
That lays the grounds for a September meeting that could be very consequential.
The more likely it is that the extremely accommodative policies of central bankers around the world will have to taper.
We should all be rooting for tapering.
We've made substantial further progress towards the inflation target.
The Fed is keeping a really close eye on the employment market.
That's where the onus is.
We need to see all-around progress in labor participation rate.
If we're tapering,
it's now a case of when and how fast.
The argument here is it September, is it November?
Or is it December? Let's bring in the team. PGIM's Michael Collins, BlackRock's Rick Reeder, and Anastasia Amoroso of iCapital Network. Anastasia, let's begin with you. Your first take, your reaction to that number from 30 minutes ago.
Well, this was a materially lower number. There's no question about it. And for anybody who was expecting the Fed to give any sort of advance notice to taper in September, that's a very disappointing number. A couple of things I would point out. First of all, this is August. This was always supposed to be a weaker than expected number, and then you throw COVID on top of it. I will say the Fed may find comfort in the fact that the average, the 3-month average, is still there. It's about 760,000 jobs. But there's one huge red flag for me in this payrolls report, and that is the fact that 0 jobs were created in leisure hospitality, and there was a decline in retail trade, and wholesale trade didn't really do much. The reason, John, I point out to those categories because that right there is about 40% of the people who are unemployed. And if the Fed cannot get those people back into the labor market, and if the Delta variant slowed the pace of hiring, that's a really, really big problem. So this is why I think the market is now pushing back any sort of Fed taper announcement to November, maybe December, because we're not really going to know whether Delta is going to recede and whether people are going to come back until we get September and maybe even October jobs report. So this was a deciding factor, I think, it's this month, and I think it's decidedly is telling us that taper is a little bit away.
235, the number, 733, the estimate. Rick Reeder, your take, please.
So I think the market's rightly discounting this number. I mean, the rates market, I'm actually surprised. I mean, I didn't think rates should go lower, but I'm surprised they're actually moving this much higher. There are a couple things. First of all, the whisper number was much lower than the consensus that was printing. The whisper number was closer to 400,000, maybe 400,000 to 500,000. There was, for some reason, there was not an education. There was 150,000 or so education jobs that should have gotten in there. For some reason, they didn't. My sense is they'll come in next month. So if you take that and you revised up last month by 100,000. So when you put it all together, I think the market's reacting right to this, that, first of all, there was a lot in August. There are supply chain issues. There are issues, certainly around variant risk. I think then the next couple of numbers are going to be strong, and I think that's why the market is doing what it's doing. Listen, I think August, you saw this across all numbers. there was clearly some slowdown. You've got UI benefits that are rolling off. I think the next couple of months are going to be really relevant. I think this month you should look at it. The component part, the leisure and hospitality, a bit concerned, but you look at wages, and particularly wages in leisure and hospitality. The question is not demand for labor. The question is supply of labor at these levels.
Mike Collins, are you happy looking through this one, looking past it?
You know, we're definitely looking through this, Jonathan. Obviously, there was a lot of Delta variant associated impacts in this number. You know, the Fed was looking forward to this August number because it's the last number they'll get before their big September meeting in 19 days from now. I think now they're going to have to probably wait another month. I thought a September taper announcement was in the bag, but I think that has to be pushed off. Remember, September, we'll get more information also on the expiration of some of the unemployment benefits. So I would not be surprised to see a big rebound there. One thing we're doing, though, looking really further into the future and how structural this is, right? I'm looking at that labor, market participation rate, and it is not moving, right? And that tells me something, right? I know Lisa was talking earlier about, is this slack? Is it scarring? I'll add another S. Is it structural?
Interesting.
Right. Slack means you just don't want to go to work now, but you will when those unemployment benefits expire. Scarring means maybe you've moved, maybe you're looking for a new career, maybe you're worried about COVID. Structural means people are getting older. It's been a year and a half since COVID hit. People have aged a lot in a year and a half, and I think a lot of people have permanently left the labor force.
That participation rate unchanged at 61.7%. Michael McKee running through the newsroom to get to this studio. Michael McKee, good morning, sir.
Good morning, or bad morning if you're a labor market employee or something like that. I got news for Michael Collins. I did not get a day older during the pandemic. So other people,
not a single day.
Not a
everybody
single
else,
day.
Mike.
It's like Groundhog Day for me every day. You can see the numbers there. They are not good. 235,000. We've talked about that. The 5.2% is good news, and it is because more people were employed than unemployed during the month. More people got jobs in the household survey. However, the participation rate, as you were just mentioning, 61.7% doesn't change at all. So we're employing more people who are in the labor force, but not more people are coming into the labor force. The number of service jobs, 203,000, and there was no change, as we mentioned, in the number of leisure and hospitality jobs, and lost 42,000 jobs in restaurants and bars. So this is just not what people had expected to happen going into this. The average hourly earnings got a lot of attention just because the numbers are big, with a 6% rise in month over month and 4.3 year over year. But basically, that's just telling you that the people who got jobs were not the people who were at the lower end of the income status. We mentioned the restaurants and food service jobs. That's going to be the problem going forward. Are these because the restaurants and bars have gone away, or is it because of COVID and people don't want to go out and get jobs, or is it because they can still make more money up to September with the extended unemployment benefits? So the September payroll report will tell us a lot about that. That's something we've got to keep in mind. It was mentioned earlier, John, the educational jobs didn't come back. Rick Reeder talking about that. Yeah. This is a seasonal adjustment problem. And this is one of those graphs that I love because it's just so easy to see. The white line is the seasonally adjusted. The blue line is the non-seasonally adjusted. And you can see what happened in July. A lot of people were out of work, but the number was pushed up in hiring because of seasonal adjustment, and this month it goes the other way. Not as much, but you can see where those jobs went. It's a seasonal adjustment question. And then just to lead in back to the group, here's what the Fed odds are telling us in terms, it's hard to do taper odds, but in terms of Fed rate rise, there had been a view a couple weeks ago, well, and certainly you can see where the red dot is after the last jobs report, that we would get a rate rise by January of 2023, or maybe even a little bit earlier. And now you can see how much that's fallen off, dropping even more today after this week report.
You wonder if that's what the bond market's picking up on. Mike McKee, thank you. Rick, let me turn to you on that. I think as a panel, everybody basically saying the same thing. You can look past this. The bond market's doing something though, Rick. Yields higher at the long end by 5 basis points on 30s, up 4 on 10s. What do you see happening there, Rick?
I mean, John, first of all, there are a few things at play. One, I'm looking at, so you think about what is actually at play here. Why are we not, particularly in leisure and hospitality, I'm looking at a chart that is actually mind-blowing. The increase in wage, if you take the 6-month annualized increase in wage in leisure and hospitality, it's up 23%. So the demand for labor and particularly in leisure and hospitality, and particularly I would argue in the entire ecosystem, is tremendously strong. You think about what is the Fed's decision process? What are they trying to influence? The demand for labor. There is no ambiguity around demand for labor. There is, do I come back? I've got UI benefits. Gosh, maybe I'll just wait for the summer to play out. Listen, I think it's pretty clear, and I think the markets are doing that. There's a lot of supply that's going to come to the market. There are certainly issues around when you look at this and you say, gosh, the broader economy is in good shape. You know, this, I think the whole dynamic around the Fed taper, the question of putting more supply, more liquidity, I should say, into the system is not having an impact, certainly not a positive impact. So I still think the Fed should be tapering. I thought they should taper it a while ago. You know, do they push it back a month or so? I'm not sure it's terribly relevant. And the markets are just saying, gosh, we got a lot of supply. These real rates aren't priced right. And this data really isn't as weak when you dig through it.
But you've said this a couple of times. You don't think this conversation about tapering is material whatsoever. Can you give us some better perspective, clarity, context there? Why?
I actually find it unbelievable. First of all, the system's overstuffed with liquidity. I mean, you look at flows this week in equity funds, in bond funds. You look at the amount of money sitting in money market funds. The system is overstuffed with liquidity. It's actually not having a positive impact putting this much liquidity in. And then when you break down the numbers that we're talking about, the Fed taper, the amount of focus on it, you know, we get 10 to 15 billion a month of taper. You get net supply of treasuries of about 250 billion a month. You get 100 billion of investment grade credit supply. You get 30 billion of loan supply. You get 30 billion of high yield supply. And we're debating 10 to 15 billion of treasuries leaving the system or not, and whether that's going to happen a month or two later. I mean, you actually think about perspective of what we have to do in the markets and the billions that get put into the system every day. The market's focused on this. And by the way, the Fed's delinking and will delink rate rise from the taper. So it's not giving you that much indication of when rates are going to move higher. So anyway, I think the whole statement, I think the Fed should have started months ago. I don't think it's having a positive impact. And certainly when you break it down in perspective in terms of the supply demand of the markets, it's actually not that significant.
Anastasia, does that resonate with you?
I think Greg's got a good point because QE is meant to stimulate demand, but I don't believe we have a demand problem. And Robert Kaplan said this from the Fed. We don't have a demand problem right now. We have supply bottlenecks, but we don't necessarily need to stimulate the demand. So it does resonate with me. But I will say from the equity market perspective, I think it would send a wrong signal if you have Delta cases surging that are clearly negatively impacting the hiring in leisure and hospitality, and the Fed tapers on top of that. I think that would send a very bad signal, and that is not what we have today, and that's why I think the markets is digesting this in a positive way, because the Fed is not tone deaf. They're likely to wait for the COVID cases to peak. They're likely to see those jobs in leisure and hospitality and retail and wholesale trade come back, and only then will they say, yes, we got the formula that we wanted to see. Now, I think, John, the conversation we're going to have in October around this topic of September payrolls report is going to be very different. And I think the Fed is going to be forward-looking about this as well. As we've all mentioned, the unemployment insurance benefits are going to expire September 6th. And that means that over 12 million workers are going to lose a lot of the top-ups or maybe full benefits. And by the way, for some of the individuals in leisure and hospitality, the income replacement ratio is 90%. So if that's no longer the case, I think you do start to solve the supply of labor issue, and I don't think we have a demand problem. So I think it's going to be a very different conversation next month.
Do we have time at the Federal Reserve? Mike Collins, does the Federal Reserve have the luxury of time on its side?
You know, I think I agree with Rick. They are going to taper. Whether they announce it in September or in their November meeting, they are going to announce it. They're going to start it probably late this year or early next year at the latest. They are going to be done buying bonds probably sometime next summer or early next fall. That's priced in. The Fed cares about what's priced into the market, Jonathan, right? So I don't think they want to push it off too long. What's happening in the bond market today, I think is pretty natural, right? The knee-jerk reaction is if the Fed is pushing off tapering, pushing off their rate hikes, you get this, you know, bear steepening. The front end stays down and the long end bears the brunt, because I think the markets are getting a sense that there are some structural limitations on the supply of labor here. So maybe the labor market is a little tighter than expected, but the Fed is going to taper, and they're going to probably start hiking rates by late next year either way.
Two's anchored here at about 21 basis points, just south of that on a 2-year yield. Your 30-year approaching 2% again at 195, at 5 basis points on the day. On the session, your 10-year at 4 basis points to 132.57. Everybody standing by. Mike Collins, Rick Reeder, and Anastasia Amoroso will be sticking with us through the opening bell. Let's get you some movers this morning at the market desk. Here's Abby.
Well, John, on that surprise downside payrolls report and that surprising move that Rick was talking about with rates, all of you, in fact, but we do have banks popping sharply higher. You can see that JP Morgan, Bank of America, Citigroup, and Wells Fargo all climbing as the yield curve steepens again as bonds do the surprise move of selling off, sending yields higher on that downside surprise for payrolls. Interestingly, usually in this environment, rising yields, a backup in yields would cause tech to drop. That is not the case here. We have big tech movers actually rising. Not big gains, but the point is Apple, Microsoft, Amazon, Alphabet are all up ever so slightly, holding steady. It's more than $6 trillion worth of market cap hanging in there, helping to explain why at this point we do in fact have the futures ever so slightly higher, John.
Just slightly positive by almost 1/10%. Abby, thank you. Coming up, a big downside surprise in a payrolls report, just as Democrats face a mansion-sized hurdle down in Washington, D.C. We'll head down to Washington next from New York City this morning. Good morning. This is Bloomberg.
This week on Bloomberg Green, how will the world's biggest polluter wean itself off of fossil fuels? We map out China's journey to net zero with one of the country's leading environmentalists.
We did see some great progress made in terms of local pollution control.
Protecting the Great Green Wall. A forest holding back the spread of the Gobi Desert is in danger of being cut down and creating a schism between China's central and local governments.
There's sort of a balance that they're trying to win. Is there's a climate diplomacy on one side, while on the other side they very clearly have some economic goals and needs.
And the dark side of clean energy. A crucial component of solar panels is being produced in secretive factories in Xinjiang. Our reporters went to find out what was inside.
Any company that's active in Xinjiang is cooperating with the regime there.
I'm Kaylee Lyons in New York, and don't miss this week's edition of Bloomberg Green on TV, Quick Take, and online.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're reminded that this isn't about politics. Hurricane Ida didn't care if you were a Democrat or a Republican, rural or urban. This destruction is everywhere. When Congress returns this month, I'm going to press for their action on my Build Back Better plan. That's going to make historic investments.
President Joe Biden promoting his Build Back Better plan, just as Senator Joe Manchin is calling to hit pause, saying the following: by placing a strategic pause on this budgetary proposal, by significantly reducing the size of any possible reconciliation bill to only what America can afford and needs to spend, we can and will build a better and stronger nation for all our families. For more, let's head down to D.C. and catch up with our Washington correspondent, Bloomberg's Anne-Marie Hordern. Morning, Anne-Marie.
Good morning, John. He's really worried about debt and inflation in this Wall Street Journal piece and the $3.5 trillion, just saying it's too much and he cannot put his name to it. And what's interesting is you're seeing the infighting already begin. Senator Manchin had voted for the markups to happen by September 15th, so he wanted to see this, but potentially the procedure for this to go, but he's asking for a strategic pause, which then makes you think, does this mean that bipartisan infrastructure potentially could be paused? Because we know Democrat leadership wanted to move these two bills in tandem. Now, we saw a swift rebuke from within his own party. You have the chair of the Progressives, Pramila Jayapal, saying absolutely not on Twitter. And then you had Senator Bernie Sanders from Vermont saying that without an infrastructure bill, there will be no, without $3.5 trillion, there will be no hard infrastructure bill. He didn't name names. He didn't call out Senator Joe Manchin in name, but it came quickly following. And this just really, John, sets up the debate that is going to happen within the president's own party.
Anne-Marie, thank you. Let's talk about that debate right now and how the bond market views things with Michael Collins, Rick Reeder, Anastasia Amoroso. And Rick, I want to turn to you straight away. Your anticipation, how you anticipate supply down in D.C. now, given the conversation we've just had on this program?
So, I mean, and with regard to this, to whether you get more supply into the Treasury market, there's a couple of things at play here relative to whether we get this bill through or some form thereof. One is you've actually got tax receipts that are growing significantly. Coupon supply is actually going to be somewhat lower because the economy is growing as it is. And listen, I mean, I think there's something that's really important that I don't think people focus on enough. There's actually too much demand. The demand outstrips the supply of product that's coming to the market. It's the reason why rates don't move up that much. It's the reason why credit spreads hold in. There is a demand for debt, somewhat because of the demographic, somewhat because of the liquidity. And so if you got additional supply into the market could absorb it quite well. I mean, we're in a period of time like I've never seen in my career where there's actually demand for yielding assets, particularly quality assets and quality income that is extraordinary and very absorbable by the markets.
Rick, that got a bit shaken, it seemed, last month in high yield. Have we started to get back onto a better footing?
John, it's a great point. I mean, the market and the loan market was a bit softer last week. You know, it's interesting, and we'll see, there's a lot of supply that's been coming into those markets. And so you get this near-term digestion issue that clearly took place in July and August, loan market, high yield market. You know, it'll be interesting to see how that goes from here. I mean, you know, when you step back, and we, quite frankly, and we talk about your show, we've cut a lot of our exposure in high yield. We've actually been adding some loans, which we think are pretty attractive here and give you obviously some protection around the rate move. But when you go back and when you think about where real rates are, there are two components to high yield. It's the risk-free rate and the risky rate, and i.e. the spread. The risk-free rate, the real rates that people are paying, when you look at are paying for these for high yield today, it's a bit rich, and so there's no doubt there's some two-way, but that's going to take place around that. But at the end of the day, the demand for yield is not going away. I mean, it is not going away this year, and I would argue it's not going to go away next year either.
Rick, you buried a trade in there, adding some loans. So I want to get Mike Collins' view on that. Adding some loans here, Mike Collins. What about that one?
Yeah, we still favor high yield bonds over loans, Jonathan, right? Bank loans are generally trading at or near par. And as we all know, they're callable at par every day. So they don't have any upside in price appreciation, whereas high yield companies are doing so well. I mean, leveraged loan companies generally, companies in general across the economy are really doing well. The credit fundamentals are improving at a rate that I've really never seen in my career, Jonathan. I mean, you're seeing leverage come down, you're seeing earnings grow so fast, and you're seeing upgrades outnumber downgrades by a wide margin, and the default rate in the high yield market is going towards zero, right? So you want that positive convexity. You want to own a bond of a company when they see improvement, the bond price can go up. And I think you have a little more upside still in the high yield market as spreads tighten or as they get acquired maybe by investment grade companies.
Anastasia Amoroso, you get the final word here. The final word, please.
Yeah, well, first of all, it's always a good idea to agree on the bond markets with Rick and Mike. But what I'll say, well, I'll throw into the mix is we got to look at the private credit opportunities in this market as well. I do think that publicly traded loans are interesting, as maybe the markets are underpricing just how far and how quickly rates can rise. But the private credit market offers you 500 to 800 basis points over LIBOR, and that's a step up versus what you get in the public markets. Most of it is floating rate, and the loans tend to do really well when you have manufacturing above 50, which is what we have today. So I make that a part of your bond discussion as well.
Anastasia Amoroso alongside Mike Collins and Rick Reeder. Sticking with us as the equity market drops a little bit lower. Equity futures down almost 0.2% on the S&P. Up next, your morning calls and later. A downside surprise on a payrolls report. Investors revisiting the question, is bad news actually good news for the market, and good news, bad news, and all of that bad stuff. Equity futures, negative 0.2%. The opening bell just around the corner, and reaction from the White House as well. From New York, this is Bloomberg.
Neptune was discovered, everyone wanted to do it because it was this clear demonstration that you can use math to discover objects.
Unfortunately, since then, no major planet in our solar system has been found. But thanks to modern telescopes, thousands of smaller objects have been discovered in the past few decades beyond Neptune, called trans-Neptunian objects, or TNOs. And planetary scientists at the California Institute of Technology have noticed some anomalies with these objects. Their hypothesis? A giant theoretical planet beyond Neptune, Planet 9. And thanks to a new telescope, equipped with the largest digital camera ever built, we may be one sky survey away from finally finding it.
Minutes away from the opening bell in New York City this morning. Good morning. Off the back of that downside surprise on the jobs report, futures just a little bit negative, going into the print positive by 0.2%, now negative by 0.15. That's the price action. Let's get to some morning calls. First up, Argus downgrading Clorox to a hold. The analysts saying shares are fully valued, with revenue declining in 3 of the past 4 quarters. Your second call from TD downgrading Charter Communications to a hold. The analysts warning of a potential pullback triggered by rising interest rates. That stock is unchanged in the pre-market at 824.31. And finally, Wedbush reiterating Apple as a top tech name to own. The analyst and good friend of this program, Dan Ives, expecting these services and iPhone business to fuel a $3 trillion market cap over the next 6 to 12 months. That stock at 154 in the pre-market, up about 0.25%. Up next on this program, a view from Washington, D.C. Marty Walsh, the U.S. Secretary of Labor, joins us with his reaction to that big payrolls miss from about an hour ago. From New York City this morning, good morning. Futures, equity futures on the S&P, negative 0.15%. The cash open next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We are about 24 seconds away from the opening bell in New York City this morning. Good morning to you all. Off the back of a downside surprise on a payrolls report, equity futures down around about 12. We're negative 0.25% on the S&P. On a Russell, down about a third. A similar move on the NASDAQ. The opening bell about to ring in New York City. There it is. Switch up the board and get to the bond market. A move higher on Treasury yields this morning. Yields higher by 3 or 4 basis points on 10s, up around 5 on 30s. It is a steeper curve with some implications for the financials that Abby will no doubt hit on in just a moment. In the FX market, euro dollar approaching 119 at 118.96. A weaker dollar in the mix here. We're positive on that currency pair by 0.2%. At the market desk with your movers, here's Abby.
Well, John, it really is an interesting reaction by individual stocks to that monster miss on the payrolls report. Largely investors not caring. But if we start out with what is working, we are going to see that both big tech, although Amazon has turned a little bit lower. And it's very interesting because earlier we had the banks higher, but now despite the fact that you have yields backing up, you have banks a little bit lower. Kind of a strange reaction and not what we had earlier in the pre-market. Turning to energy, a little bit of weakness there in sympathy with oil being lower. So odd reactions this morning to that payrolls report. Let's wait for the markets to sort themselves out a little bit. It's likely to shift quickly, John.
It is. Abby, thank you. We're negative about 0.1%. Let's get back to the panel. Mike Collins, Rick Reeder, Anastasia Amoroso. Rick Reeder, this quote from Bank of America has stuck with me for the last month. The market seems to be sitting at the threshold of a major bifurcation of scenarios with material implications for likely rates ranges, both near term and over the current cycle as well. Rick, do you agree with that? We're at the threshold of a major bifurcation of scenarios.
I don't know if it's a major bifurcation of scenarios. I think rates are going to move moderately higher from where they are today. I think you've got this extraordinary technical condition at play that's going to keep rates from moving significantly higher. I think inflation, we're starting to see, what I think the Fed is largely right, some transitory dynamics around inflation playing through. You're seeing obviously some reduction in used car prices, et cetera. So I think inflation is going to stay moderately higher. I think rates can move higher alongside of supply, alongside of a slower Fed purchase program. But gosh, I don't think rates are moving that much higher. And I think it buoys. The demand for quality income, the demand for return is nobody in the world has ever seen this before. And that will continue, and it will continue to drive investment into equities. I don't think, unless you have a significant dynamic that's different around COVID and or China slowing significantly, I don't think there's a dramatic difference in terms of how things are going to play out.
Well, I guess I've got to put the Southside research into plain English. Anastasia, allow me to do that. Just how finely balanced is the outlook for you?
I think the outlook for the broad market is balanced just fine. I think it is constructive. I think the corporates are sitting on tons of cash and good profitability. They can buy back shares. Delta cases are receding. So I think all of that is good. But the bifurcation that I do see playing out in the fall has a lot to do with the direction of the virus and has a lot to do with the direction of fiscal policy. We spent a lot of time talking about the Fed taper, and I think we've all concluded that it's not a huge market-moving event. But what I think could be a huge market-moving event is, what does the Biden administration do on infrastructure? What do they do on $3.5 trillion worth of spending? And what do they do on the debt ceiling? I think for the markets broadly, that's probably not going to, meaningfully disrupt the markets or meaningfully benefit the market. But I think it is going to create a lot of winners and losers. And for example, we had some of the big tech names on the board before. this is one area that I'm a little bit skeptical about, and put a little bit of an asterisk and maybe a risk factor next to it heading into the fall, because those names have done so well, but they are the ones that are sitting on a lot of foreign earnings and a lot of profitability that the Biden administration may want to tax as they go and pay for this human infrastructure bill. So that right there I would put in the risk factor category. But on the flip side, the other side of that, John, how about clean energy? Clean energy has been a pretty big loser year to date, down 20% or so, while the S&P is up close to 20%. But clean energy and climate change is a huge priority of the Biden administration. So there's going to be significant hundreds of billions of dollars worth of provisions for that. And all in, I think the fiscal stimulus has a decent chance of passing this fall, and I think it is going to create quite a few winners and losers. So bifurcation, I think, is going to be quite a bit under the surface for the equity markets.
Mike Collins, in about 30 seconds, I'll catch up with the White House. What do you want to hear from them?
Yeah, it's going to be interesting to see how they tailor their commentary around this weaker jobs report on the face. I think they're going to look at the big picture, right? The unemployment rate, Jonathan, 4 months ago was at 6.1. Today it's at 5.2. That is a really rapid improvement, right? We are averaging strong job growth. I think that's the message they're going to stick to. And I think it's the right message, right? We're on a really good path here. The numbers are going to be noisy month to month, but in 6 and 12 months from now, presumably the economy is going to be in a better place.
Mike Collins, thank you, sir. Alongside Rick Reeder and Anastasia Amoroso, your equity market right now down 0.2% on the S&P 500. From New York City, for our audience worldwide, I'm pleased to say on Bloomberg TV and on Bloomberg Radio, joining us now is the U.S. Secretary of Labor, Marty Walsh. Secretary Walsh, always great to catch up with you, sir. Demand in this economy, just had this conversation on this program through the morning on Bloomberg TV and radio. Demand seems to be pretty good still. It's labor supply that's being held back. By what, Secretary Walsh, in your mind, and from the view of the administration?
Say that one more. Sorry, I missed that question.
What's holding back labor supply, Secretary Walsh? What is holding back labor supply?
Well, I think what's happening here, and I listened to the previous panelists, and I pretty much agree with almost everything that was said. One of the things that we're still dealing with, particularly in the month of August, was the Delta variant. Granted, we've seen a leveling off of the Delta variant in the last couple of days here, last couple of weeks. But in the beginning of July, the end of July, early August, we saw increase in Delta variant. If you look at these job numbers and you take the hospitality number and the restaurant number, we had almost zero gain this month in that area. Meanwhile, the last 3 job reports, that was leading the way. So I think that's part of what's going on here. And it is a long game. We're looking at the long game here. We've added 4.5 million jobs since President Biden has taken office. This job report, the one thing that I would highlight is we had strong growth in the private sector, and I think we've seen growth in the public sector in previous reports. And we've seen some growth in manufacturing and auto-related uses. So again, this is a long game. There is some other tools that we have to use here. We do have 2 pieces of legislation right now that we're moving through, infrastructure bills that we need to get through. But this is the long game right now, coming out of a worldwide pandemic.
Well, let's talk about those bills right now, Secretary Walsh. This from Senator Manchin in the Wall Street Journal yesterday, placing a strategic pause on this budgetary proposal by significantly reducing the size of any possible reconciliation bill to only what America can afford and needs to spend. Secretary Walsh, what's the response of the administration to that op-ed from Senator Manchin?
Well, I think America needs investment. American people need investment. The American people need the investment in job training. The American people need the investment in the cares economy. We saw again in nursing home care and adult care, loss of jobs again. This is the 2nd consecutive month. We need investment in child care. We need investment in schools. These are good investments moving forward, and this will just continue to move our economy forward and continue to prepare us for the future of America. And I would ask, I would hope that they'll be able to work their differences out in Congress and move these 2 pieces of legislation along.
Do we need taxes on excess CEO pay to pay for that?
Yeah, that's one of the plans that the president's been talking about, a plan to pay for this. He's made it very clear that anyone who earns under $400,000 a year will not be paying any additional taxes. And we're looking at adjusting some of the tax policy in this country, and then using unspent money from the American Rescue Plan. So that's what the president's plan is as far as paying this.
Would something be directed specifically at corporate executives, Secretary Walsh? That's a story we have out at the moment that Democrats are discussing that. Have you been discussing that?
No, I mean, that's a conversation that's above what I'm doing right now. I know that this conversation is happening in the halls of Congress. It's happening with the leadership, and they'll ultimately make decisions on how to pay for this bill.
Marty, have you spoken to Senator Manchin and talked about your thoughts on this labour market and what this economy needs? Do you pick up the phone and have those conversations with him?
Yeah, I was actually with the senator a couple of weeks ago. We were we went to a coal mine in West Virginia, and we had a great day and a great chat. We talked about a lot. You know, and obviously the senator has his ideas and recommendations and opinions, and we just need to continue to have dialogue. I think the beauty about all this is that we continue to have these open conversations. As long as you have two sides willing to have conversations, that's a good process in moving things along.
Do you see it as two sides, though, considering you're part of the same party? And the reason I ask you this, Secretary Walsh, there is a narrative in the media, as you know, that the administration and your administration's agenda is being held hostage by a single senator and maybe a couple to be kind. Is that how you'd characterize the situation?
No, I mean, listen, I'm a former legislator from Massachusetts, and there's often times where I was debating a bill in the